We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories. Chinese shares gain after industrial profits surge.
Not necessarily setting the direction of travel for Asia stocks. A bit of a more nuanced, mixed picture coming through. Nasdaq futures, though, do point higher after yesterday's losses. The US 10-year yield, this is the relief, Tom, you were talking about. We see a bit of buying of sovereigns, actually, and those yields coming a little bit lower. Will that provide some relief for risk assets? And this is the Brent price, up another 0.5%, 94.45. We've been up to that 95 level and back down below it, but we wait for some key data on the energy sector today, Tom, to give us more data there.
A mixed picture on these futures then. The DAX is looking flat to lower. FTSE 100 is pointing lower by about 10 basis points. The CAC current, though, pointing gains of about 7 points, about 0.1%. We continue, of course, to watch the politics and the budget of Italy and the politics of Spain as well in the Eurozone now.
Yeah, absolutely. So we'll get an update on actually the Spanish politics, the Italian politics, the French politics as well, because we have budgets coming from various parts of Europe today. So we'll certainly get an update this hour on some of those stories. In the meantime then, Tom, as you've been pointing out, the futures picture looked pretty flat, mixed, and that's what we seem to be seeing at the start of trade. A little bit directionless here for European equity markets. Maybe US futures giving us some sense of hope for the future if you're long of these markets. Futures do point higher stateside, but a fairly lackluster start to the trading day this morning. Pretty flat, pretty mixed across the markets that are open. The same really can be said for FX markets. We saw some selling of emerging market currencies yesterday. The dollar gaining. Today looks much flatter. We are pretty flat on the Swiss franc, but certainly on the pound, the euro, even the dollar index is fairly range bound this morning. This is what we have on sovereign bonds. So we're actually seeing some of those bond names being bought today, and we've seen some of those bond yields then coming downwards. And this is a marked relief. So all of that column is in green, suggesting sovereign debt buying, and all of those yields coming down, which does offer a little bit of relief given the ramp up in yields to decade highs for some parts of the Treasury curve that we've seen over recent days. So we've got the US 30-year yield, for example, coming down just a little bit. The short end of the UK curve active as well. Just having a quick check on commodities, though. We have that mixed picture coming through on commodities that we talked about at the top of the last hour, where gas prices in Europe dropping a little bit, but they're so volatile. Meanwhile, the oil story continues to be wait and watch. Will we get to $100 a barrel? We're at just under that 95 mark on Brent right now, 94.44, as we wait for that EIA data. And the importance of this, of course, was always about the tightness of supply and inventory levels over in the United States, given what we've heard recently from Saudi Arabia.
Yeah, and the supply concerns continue to be there as well in terms of the pricing coming through for oil, as you say. That's lifting energy as a sector by 0.2%. Just reminding you that yesterday on the downside for Europe, the losses really coming through from the likes of real estate, technology and the luxury space. That has adjusted a little bit in the session today, but it does look like there's a lack of conviction generally across these European markets. Technology getting a bit of a boost given the losses of yesterday, up 0.3% so far in the session. Basic resources are flat. I talked about the energy pickup coming through from higher oil. Some other standouts, again, in a very mixed and environment where there's a lack of conviction. Banks down 0.1%. Utilities taking a bigger hit. Interesting, given that there's normally a bit of a safe haven tilt towards utilities. Currently down 0.7%. Autos continue to sell off across Europe, so that's a drag again. They were taking a hit yesterday. Autos as a sector currently down 0.3%. And that is the picture then. Broadly, your top line across European equities now down about 0.1%, Anna.
Okay, so a little bit of weakness. It's kind of looking for the next catalyst, really, aren't we, on European equity markets this morning? Sophia Horta-Acosta from our Markets Today blog joins us with some of the themes. So, yeah, a little bit of downside this morning. Sophia, waiting for new catalysts. US futures point a little higher. Meanwhile, the China story rumbles on, and that has been something that's been moving markets through the Asia session. Some better news on the economic front. Does that underscore this idea that maybe things have bottomed there? Or is it way too early to watch the property sector and wait to find out?
It seems like the market flops between being very, very negative on China and being somewhat hopeful. And I think today is a somewhat hopeful kind of day. I mean, yes, industrial profits are higher. They're still down year on year. But this is essentially saying that that kind of factory gate deflation that was really worrying economists is easing. And we're seeing a little bit of a cost base reduction there for factories as well. So kind of at a granular level, things are moving in the right direction. But only yesterday, or 2 days ago, we were panicking over the potential for more property developers to fail and kind of this house of cards. Is it actually worse than thought? Does the government have to do more in terms of stimulus? I think those questions are still in the market. And the thing is, once you miss the recovery in China, if you're not there from the beginning, then you're kind of too late because things do tend to move quite quickly when it comes to Chinese markets. Again, Chinese markets will be shut for 10 days during the holiday. So do you want to be long the market going into the break? Do you want to be short the market, or do you just kind of want to not be invested and stay away in case, again, that flip-flopping continues?
Yeah, and the property sector down, to the lowest levels since about 2011, or at least close to those levels in China. So the drag there, despite industrial profits picking up. And as you say, the holiday coming up, that's normally an important season for those real estate companies to shift some of that inventory. Switching focus to the US, though, we got the story around deposit outflows. Not a huge surprise given the rates you can get in money markets, but what is the context?
Yeah, we're seeing exactly the same happen here in the UK, obviously. Right. I mean, banks are competing. They're offering higher savings rates. So it doesn't make sense for, if you have, I mean, this is not investment advice, but if you have money in a deposit, you're obviously, you know, just normal consumer behavior is to move it to somewhere that yields more. There's a context, obviously, in the US that is unique to the US, which is the failure of Silicon Valley Bank and everything else that happened, which really kind of undermined the trust that US consumers had in consumer banks, even though they weren't really kind of rolled up in all these bank failures. This is again a function of the higher interest rate environment. So it's both a kind of a let's put money to work in accounts that kind of give you better yield, but also actually maybe kind of a little bit of cash under the mattress type of behavior after those bank failures. That
knocked to confidence over in the US. For Sophia Horta-Acosta, thank you very much indeed with the context around what's happening in China and the deposit outflows of those banks in the US. From our Markets Today blog, of course, you can get more from Sophia and the team on the front page of the Bloomberg UK website or by typing TLiveGo on the terminal. Here's what we're watching in the markets today then. 9 a.m. UK time, we're going to get ECB credit growth data for August. Anna was highlighting the fact that this is really important as a metric for the ECB in terms of how much of a squeeze is coming through for the Eurozone economy. So that comes through at 9 UK time. At 1:30 p.m, there's an update on US durable goods. To what extent is there softening there as we look at the consumer confidence surveys weakening stateside? Later at 3:30, the US EIA will release its crude inventory report then in terms of that focus on supply. Prices up again in the session today. This is going to be closely watched, of course, in terms of what is happening on prices, but also inventories of oil. And at 5:45 p.m, SNB Chairman Thomas Jordan of the Swiss National Bank then is due to speak at an event in Lausanne. Some earnings as well from the US. Chipmaker Micron is set to report after the bell.
Okay, as the oil price heads a little higher, it'll all be about that data coming out of Cushing, Oklahoma. We've seen 6 weeks of declines, depleted inventory levels, as you point out, Tom. That's going to be a focus. Coming up on the programme, Landsec drops after a Jefferies downgrade, despite the company saying commercial real estate is growing. We'll get the details. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets today. We are 10 minutes, just coming up to 10 minutes into the European trading day. There's a lot of red on that board, but none of it very extreme. We're seeing very modest losses across European equity markets. That seems to be the general direction of things, or a lack of direction. US futures pointing a little bit higher, up by 0.3% on E-minis. NASDAQ futures pointing similarly, just a little bit higher, as perhaps US stocks look to turn the corner after yesterday's negativity and the negativity we've seen recently. Let us take stock of where some individual companies are this morning. Joe Easton has a briefing for us. Joe.
So UK real estate stocks slammed in the opening of trading. As you mentioned earlier, Land Securities did say that trading has been pretty strong in central London. We've got downgrades from Jefferies, which I think we're going to bring up on the screen. They downgraded 4 companies, so Land Securities, British Land, Derwent, and also Great Portland. I don't see them on the screen at the moment. We're looking at retail as well. We've got, of course, H&M reporting that update earlier. The weather was blamed for a decline in some of their sales in September, down around 10%. So we're seeing those stocks dropping, weighing on Zara as well, owned by Inditex, and also the Primark owner. Some small declines there. But as I say, real estate in the UK is where the weakness is at the moment. In terms of some other ratings changes that we did have Adyen. That's the best performing stock in Europe today. They're upgraded at Barclays. That one really interesting. That stock down 50% this year following that big profit warning a few months ago. Then some other company specific stuff. We've got Voltalia, not a company that we look at too much. This is a French renewables firm, but it's heavily exposed to Brazil, and they're warning that the blackouts over in Brazil last month are really hitting their profits. That stock, the worst performer in France, down around 12%. Flutter in gambling has done a bit of M&A. They are buying stake in a Serbian gambling firm, according to a press release released around an hour ago from that firm. And finally, some breaking news on the Dutch insurers hit hard this morning. NN Group and ASR, they lost a Supreme Court ruling saying that they didn't provide enough information to some of their insurance clients, really hitting those stocks. They say they will appeal, but they are the worst performers over in Amsterdam this morning.
Nice one. Joe Easton, thank you very much indeed. From our equities team on some of the individual movers jumping so far, or at least in focus, I should say. Some moving higher, some moving lower. Of course, Joe Easton with the details and the context there. Thank you, Joe. Let's bring in, for more market analysis now, Marcus Morris-Ayton, Director and Senior Portfolio Manager at Allianz Global Investors. And Marcus, you're talking about the fact that European markets are underloved and under-owned. Is there a reason to turn a little more constructive on European equities, given what we're seeing in terms of the fragility of the economy? Germany is a concern. China remains vulnerable, of course, and there's the linkages there. What are you thinking about when it comes to European equities?
Yeah, Germany's certainly a concern, and predicting the short-term economy is a notoriously dangerous game. But I think if we fast forward 6 months, it is now easy to envisage a scenario where we have the inventory correction behind us, and that's plagued many industries, at a time when inflation is returning back to or around central bank target levels. And again, central bank dialogue has moved towards potential rate cuts rather than hikes. So I think at that moment in time, it is easy to see a situation where hopefully investors can return to single stock selection rather than having to second guess central bank behaviour every couple of months.
Okay, so is that view, that more positive view on Europe, is it time to fit in with the start of ECB rate cuts? Is that when it gains international momentum, do you think, Marcus, or is it going to be driven by something else?
Well, I think that's an important moment in time because that's, again, when the narrative can shift away from second-guessing the central bank to actually focusing on the underlying companies. And Europe is cheap and it's underloved, but unfortunately for Europe, it has been cheap and underloved for many, many years now. So you need a catalyst for change. And as we heard earlier, perhaps that catalyst might be a recovery in China. That doesn't look imminent in the short term. But remember, China is coming from a low base here. But I think much more important for Europe is, I always say to clients, Europe is not the highest quality region. But in Europe, there are some brilliant companies. So for those investors that are prepared to go bottom up and access those few brilliant companies, it can be pretty rewarding.
Okay, let's talk about where that takes you then, because the lift for European equities, the benchmark this year, a lot of that heavy lift is coming through from the luxury space. That's sold off in the last couple of months. And the flip side, stateside, it was all about tech, and of course tech has sold off as well. Would you buy luxury? Would you buy tech?
Yeah, it's a great question because luxury has been one of the standout performers in Europe and also globally for the last couple of years. But as you said, it has sold off. And the reasons for that are we are seeing a normalization in demand, particularly in the US, but also to a lesser extent in Europe. The flip side of that and the more positive side of the coin, though, is China is recovering from a very low base. And it's likely that China might contribute as much as 80% of global growth for luxury demand next year. So from our perspective, LVMH is a core holding for us. We prefer to access that through the very affluent customer base who are less vulnerable in a recessionary environment. And with companies like LVMH, you have great brands with good pricing power, which acts as an inflation hedge, and strong management teams. So we're still convinced in LVMH as a long-term stock.
Are you concerned? Are you on retaliation watch? I'm thinking here about the European probe of the car sector in China, and that might not stay ring-fenced in the car sector. You wonder if China decided to retaliate, where that might take us and where the luxury could be in the crosshairs, or can you just not predict the geopolitics? So, you just can't factor that kind of thing in.
I think it's certainly something we need to watch, and if China does wish to retaliate, luxury is an obvious area to do it. But I think Europe probably has more to lose than gain if it tries to embark in a trade war with China, because Europe has the potential to really emerge in a bit of a sweet spot by being in that neutral ground between the US and China. We're seeing a lot of companies, US companies that are unwilling to source from China, looking to Europe and vice versa. So I very much hope that Europe doesn't manage to drag itself into another trade war.
Okay, well, talking about the dynamics between China and Europe, central to that when it comes to semiconductors is ASML over in the Netherlands, a real tech champion for Europe in the hardware space. No other company really matches what it's able to do, and yet the stock is down, what, about 20% since the end of May. There is a concern about the cycle in terms of where we are in terms of that demand for semiconductors, and that maybe ASML is vulnerable, not just on that level, but also vulnerable as a result of further restrictions when it comes to supplying their customers in China.
Yeah, absolutely, and that's what's dragged ASML down in the short term. All semiconductors had a huge rally in May on the AI boom, but as you rightly said, we've seen a bit of weakness in the shorter term as the cycle looks like it's being pushed to the right, and there are concerns in terms of some of the bigger customers like TSMC.
And for you, that's an opening?
I think that's an opening, yeah. We're buying and holding these companies for 5 to 10 years, and so the cycle is perhaps less relevant than it is for many shorter-term investors. And actually, the way to play these stocks for many long-term investors is being a bit contrarian, picking them up in periods of shorter-term weakness. So yeah, ASML is our highest conviction position at the moment.
Tell us a bit more about the inventory destocking cycle that you mentioned, because I remember last earnings season, it was quite striking the number of companies that were still reporting some kind of issues surrounding supply chain or inventories not normalizing just yet, as if we're still in that hangover from the post-pandemic, which seems quite incredible so many months on. But what do you mean about what's going to happen? What do you foresee in this inventory destocking cycle?
Yeah, it's been a horrible challenge for many sectors, and we're still working our way through that in some sectors. But I think we are closer to the end than the beginning of that. And that will be a material inflection point, because then you might start seeing new order growth come through. Because many customers at the moment are just working their way through that excess inventory that they've got in their channels. So I think that will be an important inflection point for many industries.
Marcus, you're painting a rosy picture for us this Wednesday, midweek, and we appreciate it.
Specifically rosy, though.
Very rosy. Mike Wilson, with the specifics. Mike Wilson, Morgan Stanley, yesterday speaking to our colleagues on Surveillance, talking about the muddy picture that is ahead, warning again in terms of stretch valuations. To what extent you project out 6 months and you have this relatively constructive view 6 months out, to what extent is that assuming that yields have topped out?
Yeah, I think topped out is one point, but just we don't see the extreme rises that we have seen over the past 2 years. And when we get to a more normalised yield environment, as said, I think that's when we can again return to fundamentals.
I mean, Jamie Dimon's warning of 7%, what? That's a nonsense.
Who am I to say if Jamie Dimon's talking nonsense, but I hope so. If it does get to 7%, we have some pain ahead of us.
Yeah, and that was exactly the point he was making. I wonder what you make of capital expenditure. We're heading towards, Marcus, another earnings season. We were just talking to Henrietta Packmore from Allspring earlier on today, and she was talking about how CapEx could be good for growth. She sees CapEx increasing, could be good for growth, but a headache for central banks. Is that a theme you're going to be watching as we head into earnings season, or should we watch elsewhere?
Yeah, I think it's going to be very industry-specific. And actually, we've seen a lot of increased cost discipline in certain industries, particularly in tech, and we spoke about semiconductors earlier. So I think there you might see some softness around CapEx spend. But ultimately, we need investment to fuel future growth, whether that's at the governments, and we've got the French budget today, which will be interesting to see, especially from a green perspective. But I think it will be very idiosyncratic.
Okay, thanks so much, Marcus. Thanks for coming in. Marcus Morris-Ayton, Director and Senior Portfolio Manager at Allianz Global Investors. Coming up on the programme, we'll get back to the car sector. Tesla looms large in the EU's anti-subsidy probe into Chinese EVs. We will bring you our exclusive story next. This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Markets Today. Happy Wednesday. We are, 22 minutes into the European trading day, and you're flat across European equities. A slightly brighter picture coming through for US futures after the sell-off of 1.5% yesterday on the S&P and the NASDAQ. NASDAQ currently pointing to gains of 0.3%. S&P even is in similar territory. Let's get back to what's happening in the auto space, though. Bloomberg has learnt that Tesla is looming large in the EU's anti-subsidy probe into Chinese EVs. Early evidence gathered by European regulators suggests the US car maker is one of the key companies benefiting from Beijing's support of the EV industry. Let's get more then with Oliver Crook on this Bloomberg scoop. Ollie, Tesla then emerging as a focus of the EU investigation. Pretty fascinating, the line that it's been getting all these subsidies, allegedly. What do we know?
Well, yeah, so this is all in the lead up to the investigation before it was announced. Remember, when you launch an investigation like this, where it has huge geopolitical consequences, the EU is pretty sure that they're going to find something, right? So they did their homework ahead of time, and their homework suggested to them that Tesla has benefited from EV subsidies from China. This is perhaps not a total shock, right? This is an industry that they've been trying to build up, and Tesla's gotten really sort of unique treatment in China. They're one of the only companies that owns completely their venture within China. They didn't have to do a joint venture with anybody else. But why are they being investigated? Because they ship a ton of these EVs from China to Europe, almost 100,000 in the first 7 months of the year. That's about 50% of the total deliveries. So, of course, the irony of all of this is China's biggest EV exporter to Europe is American. And Tesla, has a factory here in Brandenburg. However, they're supplementing that with the sort of cheaper stuff over from China. The question is, they already want to build up their Brandenburg capacity. The question is, does this actually put pressure for them to do it a bit faster?
Okay, so EVs find themselves at the center of global geopolitics and also at the center of American politics, Ollie. President Biden was at the UAW picket line yesterday. What did we hear?
That's right. He went out there. He had a sort of loudspeaker speaking in front of the union there. And he's, a lot of the lines that we've heard so far that basically saying that the workers saved the auto industry back in 2008. They're doing very well now, and the workers should be doing well. Let's have a listen to Biden and see a little bit of the atmosphere there in Michigan.
Wall Street didn't build the country. The middle class built the country. Unions built the middle class. That's a fact. So let's keep going. You deserve what you've earned, and you've earned a hell of a lot more than you're getting paid now.
And he was asked, should these workers get a 40% raise? And he says, yeah, I think that they should be able to negotiate that. So really getting right in between that debate. Of course, the focus now turns to Trump, who will be in Detroit later today, skipping the Republican debate. He's probably going to focus on the fact that he says that the EV transition is actually what's killing the U.S. auto industry. The question is will that resonate with the union? It has not resonated with the union leader, Sean Fain, who has really been quite negative about Trump yesterday on CNN, saying, I don't think the man has any bit of care about workers or what the working class stands for. The question is that really what these constituencies are going to care about, or is it going to be more about social and cultural issues that have really divided the United States?
Yeah, absolutely. When they pick their battle lines, will they pick the right ones? Oliver, thanks very much. Bloomberg's Oliver Crook there with the car story and the broader politics. Tom, we should mention oil prices and oil markets because we're going to get the data out of Cushing, Oklahoma today. This on inventories. And given the run-up in oil prices we've seen and all of the conversations about whether we go over $100 a barrel again, watching the level of storage here, and we have that chart on the screen, which is at the lowest since July 2022, watching that could be crucial.
And at what point do we move from the inventories focus to the focus on demand destruction? We're looking at $100 a barrel. Some analysts say, look, it's not a question of if, but when. And at what point does the pricing just become erosive in terms of the consumer, in terms of corporates as well? The other interesting component is US shale. We're still not seeing a pickup in production despite higher prices because of concerns around labor and investment that hasn't come through for that part of the
talking
market.
about demand takes you to China, doesn't it? And a lot rides on where the Chinese economy goes. That will be a feature of our next conversation. Coming up on the programme, we'll dive into the latest out of China. We've had some better news around industrial profits coming through from China. Still a lot of focus on the negativity around the property sector, though Evergrande remains in focus. More on that shortly. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Bloomberg. This is Markets Today. We're 30 minutes into the European trading day. Let's get to your top stories. Chinese shares gain after industrial profits surged for the first time in more than a year. But China's property crisis rolls on with the founder of Evergrande put under police control. H&M shares pop after reporting a third-quarter profit beat, despite warning the autumn heat will hit September sales. Plus, the US FTC sues Amazon, accusing the e-commerce giants of monopolizing online marketplace services. Those are the headlines then, Tom. In terms of the underlying picture, actually, stocks recovering a little bit from some nervousness earlier on.
Yeah, a bit of a turnaround in sentiment. It is modest, but there are the gains now, 0.2% across your European benchmark after, again, 4 straight days of losses for European stocks. So looking through higher oil prices, a big component has been the money moving into bonds as well. So bonds are bid, equities bid, and yields are coming down. We continue to, of course, monitor the politics of France, Italy, Spain. You've got budgets being formed in Italy and France, and then the politics of Spain as well, which could be important. We also heard from the ECB's Holtzman right on the edge of the hawkish spectrum from the ECB, and he's suggesting that they're not sure whether they're done in rate hikes. Would you expect a slightly clearer message from the ECB and a clear hawk there on whether or not he wanted further hikes is maybe a question as well as we weigh up where central banks go from here. The DAX is currently flat across the main benchmark in Germany. Of course, auto's getting a bit of a lift after pressure on that sector in recent days. The FTSE 100 here in the UK, 7,625, unchanged. You're still below that 7,700 level. Let's flip the screen and see things how things are breaking down on a sector-by-sector basis, given the heavy sell-off that we saw yesterday in real estate and technology and luxury in particular. That narrative has changed a little bit this Wednesday. So as I mentioned, autos coming up about 0.4%, a bit of a lift for that sector. Travel and leisure getting a bit of a gain as well, up 0.2%. TUI was a major drag on that sector yesterday. Energy gaining 0.2%, and a couple of other sectors that stand out. Tech pairing the losses of yesterday, up 0.6%, but the losses when it comes to the downside, most pronounced in utility so far. That sector down 0.7%. Anna.
Tom, let's talk about China. Now, the Chinese President Xi Jinping is currently attempting to lead the country out of an economic slump that has had global investors on alert over the summer. Markets are also keeping a keen eye on local political stability. The Defense Minister, Li Shangfu, was recently removed along with a group of generals overseeing the country's nuclear arsenal. Back in July, Foreign Minister Qin Gang had mysteriously left his post after just 7 months, the shortest amount of time anyone has spent in that job.
Okay, for more, we are joined by Kerry Brown, Director at the Lao China Institute at King's College London and author of Xi, A Study in Power. Kerry, thanks for your time this morning. Let's start with a question about, well, some have phrased it a purge, some have phrased it as a reshuffle. Certainly there is a lot of confusion around what has happened to the former Foreign Minister Qin Gang and, of course, the head of the military, as well as some of the military officials in charge of the rockets part of the PLA. What is your take in terms of what's happening? Confusion here. Is this a Xi Jinping who is grappling with the challenges of corruption or flailing after pushing through some of these appointments?
I think the more key issue is that it's a Xi Jinping who's dealing with a pretty difficult international environment. I mean, those two positions, the foreign minister and the defense minister, are pretty outward-looking. They're looking at a world which, for China, is, you know, kind of incredibly important because it's an enormous economic and political, you know, kind of a sort of ally in many ways, but also an enormous problem, particularly the United States. Qin Gang had been ambassador briefly in the United States and reportedly fathered a child there with a Chinese national, but born in America, so therefore presumably American. Li Shangfu is a different kind of person because he had an enormous technical background. I mean, he was really a sort of engineer and technologist, and so really a technocrat. These are not political allies necessarily of Xi, so they're expendable, and they're not really high up in the hierarchy, but it creates uncertainty, of course, this sort of action.
Yeah, does it tell us anything that these were people who were handpicked and are said to have risen under Xi's leadership rather than under predecessors? From the outside world, it does make things look kind of unstable, but is that the right takeaway from this, from all of these developments?
Oh yeah, these people are completely Xi's people, but they're Xi's sort of lower to mid-ranking people. They're not, you know, they're kind of absolutely core allies around him. If this had been one of his Politburo Standing Committee, you know, colleagues, well, then we would really be talking about, you know, kind of fragmentation of the elite. And that is not apparently what's happening at the moment. What we're seeing is a fairly clunky system where, you know, your appraisal will mean that you either continue in your job or get booted out unceremoniously. Both Qin Gang's case and Li's, well, they weren't given, you know, there's been no real statement by the Chinese government, certainly in Li's case, about what's happening. And for Qin Gang, the weird thing was he sort of maintained positions like a state councillor after his, you know, in inverted commas, removal. So these are sort of, you know, kind of a bit messy. They don't seem very purposeful. They seem more accidental than deliberate.
Kerry, I just wonder if you add the messiness of some of these changes at the top of some of these ministries and government departments in China, along with what some would argue are policy missteps on things like COVID, for example, the reopening and the failure to build out the capacity around getting vaccines in arms, the hospital capacity there, but also missteps arguably on real estate, on technology and the crackdowns there, the soaring youth unemployment. You put all that together and you can make the argument that Xi Jinping is something of a paper tiger.
Well, the problem is it's a capacity issue. I mean, what you've got is this massive system centralized in one individual. And it's a bit like, you know, you've got a concert and you've got the lead act, and then the lead act is totally reliant on the lead singer and no backup, right? So there's no backup for his performance. And I mean, that's sort of a structural problem. It will probably get worse as we go forward because he has to make all the decisions. No one really dares to do anything without, you know, kind of making sure that he's comfortable with it. So, you know, kind of you've got this issue of someone who's got to have one bad day for there to be a big problem. And, you know, kind of it just has to be one bad day. He can't be on top form all the time. This is, I think, where we get some of these strange decisions from. It's too reliant on him.
Kerry, when we look at what Western companies make of China, exposure to China, investments in China right now, a survey by the American Chambers in China revealed that Western companies, their levels of gloom are at the highest level that they've reported, they've identified in decades. We've seen an exodus from stocks, an exodus from bonds. Are these the kind of news items that influence thinking in China, or is the view just insulated from all of that?
I think we're in the kind of biblical 7 lean years now. If you're there, you've got to kind of basically tough it out because I think better times will be ahead. If you're a new entrant, I think it'll be really, really difficult. It's so hard to read this market. For those who are there, like BASF, you know, huge new investment of 10 billion, I think, US dollars. Others, they're doing okay. I mean, Japanese, I looked at their investments and their kind of returns last year. Into this year, it's doing fine. I think it's record levels. I mean, Australia, I mean, you know, because of the raw materials, they're doing absolutely fine. But I think if you're looking to crack the service sector market, I mean, that is really, really tough at the moment. There's still no big agreement between Europe and China. I mean, there's lots of problems between America and China. People are doing some things there. It's tougher. You have to follow the rules more. The new security rules are difficult. The data protection rules are sometimes very vague. And as we've seen with Nomura Bank, you know, one of their chief personnel can't leave China at the moment. I mean, this is an uncertain environment.
Okay, the slim 7 years. The other uncertainty, of course, coming through, and this time from Brussels, but the question is to what extent and how Beijing might respond. What is your take, Kerry, this probe by the EU on Chinese EVs? We've been discussing about the fact that Tesla is going to be a primary focus, ironically, to some extent, for the Europeans. How do you expect the Chinese to retaliate if indeed they do?
It's a bit of a replay, I think, of the solar panel issue from, I think that was about 15 years ago. I mean, the problem is that China has just sort of produced so much. Its capacity is massive. And of course, I mean, that's a market issue. I mean, I don't think, I mean, 15 years ago, there was a pragmatic solution eventually. I mean, maybe there will be this time. I mean, China is in a very strong position. I mean, it has got capacity. It's got its own massive domestic market. I mean, I think most of the cars sold in China now are electric cars. I mean, it's, you know, kind of in a very, very dominant position. The European market is still very important to it, though, so, you know, it may well compromise. I mean, that's really dependent on the political and negotiating skills of you know, the Europeans, and they've been okay in the past. I mean, they're facing a stronger competitor now.
Thanks so much, Professor. Really good to speak to you. Professor Kerry Brown, Director of the Lao China Institute at King's College. Thanks so much for joining us this morning. Coming up on the programme, climate spending will be front and centre of France's new budget, which will be unveiled today. We'll bring you up to speed with that. We've also had news developments out of Spain, out of Italy. Plenty to talk about when it comes to politics. But Macron's green plan, front and centre. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations.
Let's check in what you need to know.
Welcome back. This is Markets Today. We are 42 minutes into the European trading day. Very modest gains occurring in European stocks of about 0.1% across European equities. US futures pointing to gains of around 0.4%. Let's stay in Europe, though, with a focus on what's happening in Spain. Spain's opposition leader, Alberto Núñez Feijóo, is facing a vote today in his bid to become prime minister. If the People's Party leader fails to get fellow lawmakers backing, he hands his opponent, Pedro Sánchez, a clear shot at forming a government. Joining us now, then, is Bloomberg's Rodrigo Orejuela. Rodrigo, what is the latest, then? Today's the first vote, it seems, to elect the opposition leader as PM, and it looks like he's set to lose. What's going on?
Yes, it is a rather strange situation in which the person who comes in as the winner or the first placed candidate in the elections and who has the mandate to form a government comes into the debate and comes into the confidence vote with not enough support and isn't able to get it. That has never happened in Spanish history in this way. And he has used this entire debate and this vote as a place or a situation to frame his opposition strategy against Sánchez for a new potential Sánchez government. So at the end of the day, this was supposed to be a confidence vote. It is a confidence vote formally, but it also is a bit of an opening salvo for Sánchez's own attempt to form government within the next few weeks. As you said, this is the first vote. There's a second vote on Friday, which Feijóo is also expected to lose. And then Sánchez has roughly 2 months to try and do it himself. And then if he is elected, if he gets enough support, he will be prime minister. If not, we could head into new elections in January, where we would see what happens.
Rodrigo, thanks so much. Rodrigo Orejuela joining us there with an update on Spanish politics. Let's go to France now. The French government will present its budget today. It's a test of voter appetite for pouring public money into the climate transition while withdrawing support for inflation-hit households. Really important resonance across Europe, this story. Now, the budget is also set to delay previously promised tax cuts. So what should we expect from this? Caroline Conan joins us then from Paris. Caroline, where do you expect increases and then budget cuts?
So the French government has promised to find at least 16 billion euros in savings. So a lot of this will come from the phasing out of the financial aid to support households and companies to pay their energy bills. That was put in place, of course, to face the energy crisis. And as you mentioned, there will be some delayed in planned tax cuts on production. And also households like me will have to wait for the promised tax cuts of 2 billion euros for at least a couple of years. However, in terms of new spending, there will be a lot of focus on the green transition. Macron wants to spend an extra 7 billion euros for the green transition in the next budget. So that means the total budget for the green transition will go from 33 to more than 40 billion euros next year. But of course, the government knows that they're walking on thin ice because, of course, to finance all this, they don't want to raise taxes. Last time they tried to do that, remember, with the carbon tax back in 2018, that sparked a cost of living wave of protests across the country, the Yellow Vest protests. So Macron needs to find some savings without raising taxes to finance this green transition. Of course, it is a balancing act at a time when French growth is also slowing, 1.4% expected next year. And Macron has also promised, of course, to cut the deficit. And of course, you have the higher interest rates, which are increasing the financing cost of the debt. So the debt burden, the financing of the debt for France will go from around 40 billion euros this year to more than 70 billion euros by 2027, which is the end of Macron's mandate. So quite a balancing act today in this budget.
Yeah, the Gilets jaunes then haunting maybe Macron on this. 40 billion for the transition over in France. Meanwhile, here in the UK, we're walking back from our green commitments, but that's all fine. Caroline Connor, thank you very much indeed on the latest when it comes to the French budget. Let's focus on Italy now. Italy to present an update on its budget outlook later today. Bloomberg has learned that Prime Minister Giorgia Meloni is paring back her ambitions to bring Italy's deficit towards the EU's coveted 3% limit next year. Let's bring in, for the details, Bloomberg's Rome bureau chief, Chiara Albanese. Chiara, the new budget forecasts then, they're likely to be worse than the ones that were released by the government earlier this year. What has made that the case? Where's the deterioration come through?
It is definitely worse, but all comes down to a matter of perceptions, and at the end of the day is not that bad. So the main impact is an extra cash bonus that was introduced by a previous government, a so-called super bonus, which actually is having a big impact on the deficit number this year mostly and next.
And Chiara, away from the budget story, which clearly is something that BTP markets will focus on, we've just learned that the government in Italy is seeking to create a new banking hub. They want to try and create a third big banking business to rival the top two. This seems to be an ongoing story. What's the latest?
Exactly. This is an ongoing story. The government has been holding a majority stake in Monte Paschi. It is the world's oldest lender, extremely newsy and mediatic. Now, the government wants to sell it by a 2024 deadline, but it wants to do that leaving a mark. And its plan and its way to leave a mark will be to basically rival the duopoly of Intesa Sanpaolo and UniCredit by creating a third banking group with merger, which is easy to write, but not so easy to implement.
Okay, Chiara Albanese, Rome's bureau chief, of course, Bloomberg, in Rome, in the Italian capital. Thank you for the latest on the banking sector and a preview of the budget and the constraints for the Prime Minister, Giorgia Meloni. Coming up, tightening markets outweigh dollar gains, pushing Brent crude higher in the direction of the $100 mark. 94.57 currently on Brent. We get the analysis next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets Today. We are 52 minutes into our trading day, and European equity markets recovering a little from earlier losses. US futures points increasingly higher, up 0.5% or so on Nasdaq futures. Let's talk about what's happening in these markets. Eddie van der Veld joins us from our Markets Live team. Eddie, and we're going to get data today from the EIA around inventory levels on oil, and as we wait for that, oil goes higher again, 94.58.
Yeah, there's a lot of focus on the oil market, right? And you've got backwardation, you've got those time spreads. Showing that there's real tightness in the market, and you are seeing Cushing inventories fall probably again today. I think the focus on Cushing is a little bit misleading at the moment. Oil is flowing through the US in other paths, and therefore that's not the main inventory point, but nevertheless, because it is the best known, that's where investors are focused, and that will move prices. I do think that the oil rally looks a little bit overdone.
The oil rally looks a little overdone. We had a bit of a chat about this, Anna and I, earlier in the show, about demand destruction. Do we have any clarity on what price level gets to that point where you start to see a pullback?
Look, I think investors or consumers are already in the conference board number yesterday. They told us, look, we're worried about our spending. I don't think you see a lot. You don't typically see people stopping driving when oil prices go up first. They typically stop spending on other things because you still have to get to work. You still have to pick the kids up from school. You still have to do the other things. So you fill up your car. But demand destruction in oil is a longer term. The short-term elasticity, price elasticity is much lower than the longer term. So in the long term, you see people moving to EVs and other things.
Right, absolutely. That's the long-term shift. And I wonder if the short-term dynamics actually vary a lot depending on how recently you just saw a spike in oil prices, because we're coming off a spike in oil prices, of course, driven by war, by Russia, and of course, depleted savings levels post-pandemic. So maybe the reaction function to certain levels of oil price now different to what it would have been at another time. Let me ask you about BTPs and that area of focus right now, because we heard just yesterday, according to our reporting, that the government under Giorgia Meloni is going to target a less aggressive target when it comes to deficits.
Yeah, absolutely. Look, we've got yields rising in the Eurozone, not today, but broadly we had yields rising. Growth is slowing. We've got an Italian budget. I kind of feel like I've seen this movie a little bit before, right? At the moment, it doesn't look like investors are overly worried about what's happening in Italy. They are talking about a slightly larger budget, deficit, but the market doesn't seem to be so concerned that we're seeing yields blow out. However, investors with a long enough memory will, look back towards the Eurozone crisis and say, if this continues, maybe we get a replay. So I think if we get a drag on, those BTP spreads will be interesting.
You asked a really interesting question of our guest earlier around, does this take us into worrying about the periphery once again? And actually she made the valid point, well, we need to worry about the core too this time around, given the pressures on Germany.
Germany was what her answer was. About Italy, she's like, hang on, what about Germany? When it comes to the treasury markets, you're seeing a bit of relief in terms of that sell-off that we've seen that's caused so much angst. Yields coming in by about 7 basis points on the front end, 5.04. Really interesting. We were speaking to UBS's Manu Boeja on the close show yesterday, and he said, look, the 2-year is a screaming buy right now. How are you thinking about the actions in the treasury market?
Yeah, you know what? I've changed my thinking over the last couple of days on this, right? We used to think about the steepening, the bear steepening, as the relatively painless, economically most benign outcome. I think the market is starting to tell us that we don't want to see a bear steepening, we don't want to see a bull steepening, we want to see a steepening twist, right? We want to see front-end yields coming down a little bit because the Fed is maybe, but not so sharp that they forced into, you know, cutting by 100 basis points, and at the same time, the back end starts building in that term premium. And I think that's what the market wants to see, a steepening twist.
Okay, I remember Operation Twist. Got to go back a decade or so. It's not a dance move. Google it if you don't remember that one. Eddie, thanks very much. Bloomberg's Eddie van der Veld from the Markets Live team. Tom, just wanted to mention some data that's due out at the top of the hour. Credit data out of the ECB. Our colleague David Powell at Bloomberg Economics Flags reminds me that the last time we got this data, it showed the biggest drag, showed the drag on spending from credit provision was as large as at the depths of the Euro crisis. So there's a parallel to
and
look
whether
back
that
on.
credit data changes the views that we're hearing from the ECB, because of course if that tightness is there and the cracks are starting to form, maybe the cementing of the pause has to be there for the ECB. That is it, of course, for markets today so far. You're looking again at European equities up just 0.2%. US futures pointing more positive though, gains of 0.5%. Plenty more coming up. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. European shares mixed against the backdrop of higher for longer U.S. interest rates, as well as the property crisis in China. Over in the States, the FTC files a landmark lawsuit against Amazon, accusing it of monopolizing online marketplace services. Will bring you any pre-market moves that we see. Plus, the ECB hawk Robert Holzman telling Bloomberg it's unclear whether the central bank has lifted borrowing costs to their peak. We're going to bring you more of our interview throughout the hour. A quick look at how European markets are faring, a quick check on the map, because green on the screen across the board. This is really interesting, especially as we get some data coming out. The Euro area August loans to companies rising about 0.6 year over year. Now, look, this usually isn't that market moving. You're probably not seeing a big reaction off the back of it, but it is good to know that that loan growth is there on a year over year basis, because at the end of it, it does actually matter from a macroeconomic perspective just how much loan growth and by extension economic growth you are actually seeing. When you look at the maps, though, you are seeing some outperformance, specifically in the CAC 40, the French index higher by 0.3%. Again, I wouldn't call it major movement to the upside, but you are seeing sentiment actually increase. And this makes sense because the backdrop lately around the world has been sell, sell, sell. So naturally, you are kind of entering a point where you have to perhaps buy the dip. And that feels like some of the sentiment driving the European trade right now, and potentially setting up the trade in the United States as well. Let's get you some of the major charts we are watching this morning, because, of course, the FX story is top of mind, specifically around the Swissy. So I bring you this chart. Essentially the idea that, of course, last week we were surprised by the S&P that they were actually hitting pause on those rate hikes. What that does, though, is remove the impetus, remove the momentum for actually diving in to the Swissy. No longer do interest rate differentials actually favor the currency, which is why you are actually seeing dollar Swissy stronger and stronger for, I believe, 11 sessions now. This is its worst run, going all the way back to 1975. It tells you that again, if you start to pause rates in Switzerland, in the rest of Europe, suddenly that does actually create another tailwind for the dollar, which brings us to the ripple effects there. Because if you see a stronger dollar, what is the first commodity that gets hit? Well, we all think oil, especially on the march to $100 a barrel. Here's a chart that shows you why we're getting closer and closer to $100 a barrel, with oil at, I believe, $95 right now. Actually, the inventories are a big part of it, specifically in the United States. Look, it is their lowest, going all the way back to July of 2022, really speaking to the physical tightness you are seeing in the market. Going cross-asset, though, oil higher usually should mean risk sentiment is higher, too. That is not what you're seeing in the equity market, specifically when it comes to the tech story. And that's really where I want to go next. The idea here that tech is actually entering a correction. That means, yes, a 10% drop from its peak back in July. In the broader index, a 7.2% decline. Now, what that means, though, is simply that as we get to the bigger and bigger declines, the selling accelerates. Does that make sense from a fundamental point of view? Well, some might argue maybe, especially with the news that we got overnight coming out of Amazon. The FTC suing Amazon in a landmark antitrust case over in the marketplace. What's interesting, though, is that even though in yesterday's session with that news, the stock dropped about 4%, dragging down the entire index, in today's session, higher by 0.4%. Is that a positive sign? Well, some would argue it's simply buying the dip. And remember, every time a lot of these cases have hit the antitrust story from the FTC, the stock hasn't actually suffered. You see that time and time again. Does that signal some sort of faith in terms of the FTC's success rate? Or do people just not care? Who better to ask than our next guest? Maria Minucci joins me right here on set, fund manager over at M&G Investments. Let's start there, Maria. The tech story. We're talking about all this antitrust regulation. How much of that matters in an environment where selling has really snowballed?
I think tech has been extremely interesting this year, especially after the behavior of 2022, where many investors were worried about the sector in an environment of rising interest rates and how that might affect valuations. But really what we've seen in 2023 is a completely different story. Interest rates were no matter anymore for the tech sector, and really the artificial intelligence focus has driven a lot of the sentiment in this area. We certainly see a bit of a softening of that narrative. I mean, if we look at individual stocks like Nvidia, which have done exceptionally this year, the last phase, they're starting to weaken again. But this is also in the context of a market that has become probably more complex over the summer months, with investors paying more attention to what higher for longer might mean from a rate perspective, and therefore affecting both fixed income and equity markets.
Yeah, a dynamic you're seeing really around the world. This is no longer just a U.S. story, European story. Everyone now suddenly on the same page. But when you do look at the equity market, both in Europe and in the U.S., it's pretty normal to see pullbacks of 2%, 3%, even 5% a couple of times a year is fairly normal. A 10% correction in tech, a 7.2% drop from the July peak. Is this a bear market in the making?
Well, I think we also have to consider where we're coming from, right? The uptake in the beginning of the year, the first part were extremely high, more than double digits. We've seen some companies, high, increasing more than 100%. So, if we put that drawback in context, we might see a slightly different picture. And it's no surprise that the tech has been driving a lot of what has happened in other markets as well. But what has been particularly interesting this year has been differential behaviors across different regions and across different sectors. Tech being one, but also if we look at a more regional perspective, we've seen regional equity performed very differently, with Japan being a very interesting area where we have seen opportunities in the first part of this year, and that have continued to rally and do very well, specifically in sectors like, for example, Japanese banks.
I was going to say, right off that potential interest rate move, I should say, out of the BOJ, suddenly Japan investable again, it feels. Well, Maria, stick with us, because in addition to all the technicals and the fundamentals you just talked about, a little bit of geopolitics getting wrapped into the story. The U.S. government on track for an October 1st shutdown, despite incremental progress late yesterday in the House and Senate on rival spending bills. Joining me now, Bloomberg's Bruce Einhorn, joining us for a little bit more context. Bruce, we're heading for a shutdown. What's the update?
Well, on the Senate side, there's progress being made on a bipartisan bill. They're likely to vote on that sometime over the weekend. That would be a continuing resolution, so that would keep the government open sometime until around mid-November. That would give them more time to work on a more longer-term fix to the issue. That would include disaster relief funds. It would include aid to Ukraine, not as much as the Biden administration has asked for. However, the problem is that at the moment is a non-starter in the House. And the thing to remember there is that Kevin McCarthy, the Speaker, has a very small majority, only a handful of seats, can't afford to lose any votes. And one of the things that he agreed to the beginning of the year in order to get the speakership was a concession that would allow any individual House member to put in a motion to vacate the chair, in other words, to get rid of the speaker. And there's a group of Republicans in the House who are opposed to any continuing resolution, who have vowed that if there were to be a bipartisan bill that Kevin McCarthy allowed to go forward to get a vote and would almost assuredly pass, that they would then launch a move to depose him as Speaker. So at the moment, there's a bit of a stalemate among the Republicans, that there's no agreement in the House about what to do, and therefore most likely there is going to be a government shutdown. The big question then is, how long does it last? We've been through several shutdowns over the years. Typically what happens is the pain builds and one side eventually agrees to compromise and they move on. So we'll see what happens this time, Kritik.
I mean, the jury is still out. It could go in any direction. Bruce Einhorn, thank you, as always, for the update, joining us on that crucial story. Let's bring back in Maria Minucci, the fund manager over at MNG Investments. Look, Maria, Bruce just said it. This government shutdown kind of looks like it's coming. It's on the cards. Things aren't looking super rosy there from a political perspective. Moody's had warned this past weekend that if indeed we do see this government shutdown, suddenly the odds of a credit downgrade get way, way bigger. And of course, we know Moody's is really one of the only holdouts over a decade later from the 2011 kind of AAA downgrade as well. The reaction off that back in 2011 was defensive. Everyone around the world went in, dived into the bond market. Do we see that happen again if Moody's downgrades the United States?
Well, I think it's quite interesting in terms of trying to understand, on the one hand, what the practical consequences of that will be, and of the U.S. shutdown in general, so for the domestic economy, but also more from, like a behavioral standpoint, what might that mean if you have a prolonged U.S. shutdown, and even worse, if you have an effect on credit rating for treasuries. And I think potentially we are already seeing some of that nervousness in markets more lately. We have seen quite a significant significant move on the US curve. In particular, we have seen that happening at the long end of the curve. And yes, of course, we could justify that by saying it's about higher for longer, is investors trying to work with this highly inverted curve and trying to understand what higher for longer actually means. But when we look at maturities like 30 years treasuries, there is potentially some nervousness also linked to the creditworthiness of treasuries per se. And I think given some of the rapidity of the moves that we have seen, specifically past the 4.5% level of yields, there might potentially be some opportunities there for a relief should things go smooth from a US shutdown perspective.
Is this that moment at the end of the day that is the catalyst for bond bulls to really go back to being in the driver's seat? I feel like that's going to be the question. Maria Minucci, fund manager over at M&G Investments, thank you for joining our program this morning. Coming up, Italy seeking to turn Banca Monte Paschi into the country's third largest bank. We're going to find out why next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, Italy speaking to turn Banca Monte Paschi into the country's third largest bank by merging it with one of its peers. Bloomberg has learned that the government is holding informal talks with advisors. Meanwhile, the Italian government presents an update to its budget outlook later today. Bloomberg understands Prime Minister Giorgia Meloni is paring back her ambitions to bring Italy's deficit towards the EU's 3% limit next year. Now, a lot going on in Italy. Who better to parse it all with us than Bloomberg's Rome Bureau Chief Chiara Albanese. Chiara, a pleasure to have you on the program this morning. Let's start off with the Monte Paschi deal specifically. Talk to us about the logic here. We know that this is a bank that has been nationalized for a while, then brought back into the private sector. Why this merger and why now?
The government has to sell its controlling stake in Monte Paschi by next year, and this is a very clear deal that it needs to do. But now it is going further. So Giorgia Meloni wants to leave a mark and make this deal into a signature of her government. And the way she wants to be is to create a new banking group that would rival Intesa San Paolo and UniCredit. Now, while the plan is very clear and is very ambitious, it is at the moment very hard to implement because there are no buyers for the bank.
Certainly a tough one, but I mean, what a comeback if this is indeed executed for, I think, one of the world's largest banks, or if not the oldest bank that we have seen in Europe and potentially the world. Chiara, at the same time, we're seeing Giorgia Meloni's government also presenting its budget today. We know that money is a really big issue for really all the governments in Europe. What could come from today's budget update?
So there are two numbers to look at, and the first one is the deficit that is going to be presented for next year, which is likely to be up to 4.5%. We reported yesterday. Now, the other element we really need to look at is whether it is on a descending path from this year, and this is set to be the case, and this is set to be very welcome by the European Union.
What does this then do for the bond spreads? I mean, we're watching this very closely, the French budget as well later, and the impact into kind of the Bund spread and the French debt as well. But BTPs are also the risk factor. What is the BTP read-through?
So the BTP and investors have been, until the summer, quite positive on Italy. They were reassured by Meloni's government and the measures it took. But at the moment, they are growing increasingly edgy for a few measures, but also due to the spiraling debt that Italy has. So clearly, if the budget will not reassure them, we should definitely expect a move in the BTPs tomorrow and after markets will open after the budget.
We'll certainly keep an eye on that. Major market moves. Bloomberg's Chiara Albanese all over that story in Italy for us. Thank you for joining us this morning. Well, we're just talking about the Bund BTP spread. Chiara talked about the BTP side. Let's talk about the Bund side. ECB hawk Robert Holzman saying it's unclear whether the European Central Bank has lifted borrowing costs to their peak. Holzman spoke to Bloomberg's Zoe Schneeweiss. Take a listen.
Inflation is full of surprises. And as a result, we cannot say for sure now we have reached the peak and no more increase. The reason is that the inflationary pressure is still on, and that just these recent days we have seen how much energy prices have surprised us.
Zoe Schneeweiss joining me now for more on that interview. Zoe, let's start with kind of the hawkish narrative here, this higher for longer conversation. I mean, the markets are very confused about just how sustainable that dialogue is going to be. Your take on those comments?
So Holzman obviously is an expressed hawk. He's one of those most hawkish members of the Governing Council, and he wants to make very clear that this hike, which a lot of market participants and also a lot of his fellow Governing Council members do see as the final move in this rate tightening cycle, that more could happen. He is in particular worried about inflation. As you see, he mentioned energy prices. We've been, this threat of $100 oil is back, and that's one of those things that might just force the ECB. At the same time, he does say force. It's not like he wants another hike. He just thinks the inflation data might force the ECB to do something.
So that's the hawkish narrative, to your point. Let's talk about rate cuts here. I mean, rate cuts are something that have been kind of pushed off the table, at least in conversation, by President Lagarde herself and, frankly, around the world. But, Zoe, what is the case for rate cuts and where could they be built?
So I did ask Robert Holzman about this yesterday. He said, and that is a narrative that makes sense, that if there are rate cuts, that would mean that the economy is in dire straits, that the economy cools down so much, goes into a recession, and that then in turn means that inflation, that feeds through to inflation, and inflation then finally goes under those 2%, is low. It goes so low that something has to be done. As you mentioned, markets expect this in about July. Some economists also say June or July might be possible. Most of them, though, say it'll take a bit longer. There even are a bunch of economists who say that rates will stay steady all through 2024. So that would be quite a high rate peak.
I mean, the timing is really interesting here. You're saying kind of June and July of next year. You talk to a lot of economists, and they're saying that the recession calls are in the back half of 2024. So arguably, the markets are pricing in that the ECB and the Federal Reserve alike are actually going to be on it this time. Bloomberg's Zoe Schneeweiss, we'll see if that actually pans out. Thank you for the interview, and thank you for joining us this morning. Much more ahead. Stick with us. This is Bloomberg.
Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
On the next episode of Hello World, I head to Los Angeles, meet some robots, then eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now let's get to some of the other top stories that we're watching on the Bloomberg terminal. JP Morgan has announced 2 more settlements to resolve legal woes over its banking relationship with the deceased sex offender Jeffrey Epstein. The biggest U.S. bank has tentatively agreed to pay $75 million to the U.S. Virgin Islands and also reached a confidential agreement with former executive Jess Staley. The lender also settled with Epstein victims for $290 million back in June. Sticking with U.S. banking, bank deposits have declined year over year for the first time in data going back to 1994. Following a tumultuous period for the banking sector, total deposits at U.S. banks ended the year at around $17.3 trillion, down about 4.8% from 3 months ago. S&P Global Market Intelligence says higher interest rates incentivize depositors to withdraw cash and seek higher yielding alternatives. And in New York, a judge has found Donald Trump liable for fraud, a major blow to the former president in the biggest civil case he faces. Trump is accused of exaggerating his net worth by billions of dollars a year on financial records submitted to banks and insurers, both of which he denies. The ruling resolves the state's biggest claim against President Trump ahead of a non-jury trial set to start as soon as October 2nd. OpenAI is reportedly talking to investors about a potential share sale that would value the startup at $80 to $90 billion. The Wall Street Journal says the valuation would be almost 3 times what the company was worth earlier this year. The deal would allow employees to sell their existing shares instead of the company issuing new ones to raise fresh capital. And in the U.S., retailer Target is closing 9 stores in 4 states to stem losses from rising retail theft. The company has been fuming on its earnings call for more than a year about losses from theft, which are adding pressure on slender profit margins. In May, the company said inventory losses from external and internal theft would be $500 million worse this year than the last. Another story we're watching on the corporate space is, of course, Amazon. We're watching those shares very, very carefully as they are higher 0.2%. What's important to keep in mind here is, look, the FTC has come in overnight and said that Amazon is basically in violation of U.S. antitrust law. But remember, this is something that a lot of people were expecting from Lena Khan, the head of the FTC, as she actually wrote her thesis on it. Does it impact the stock? Well, it did yesterday. Let's see if it does today. More on that after the break. Stick with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
European shares are higher despite the backdrop of higher for longer U.S. interest rates and, of course, the property crisis in China. The U.S. FTC filing a landmark lawsuit against Amazon, accusing it of monopolizing online marketplace services. Plus, ECB hawk Robert Holzman tells Bloomberg it's unclear whether the central bank has lifted borrowing costs to their peak. We'll bring you more of our interview throughout the hour. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. Some breaking news here. Mitsubishi Motors now is saying they're going to end their production in China, that according to the Nikkei. When you look at the immediate market reaction, remember they are listed in Tokyo, so those markets are closed, but you are seeing them listed in the U.S. as well. Not any major moves coming off of the headline, higher by about 0.6% on the ADRs, which I'm reminded are not very liquid at this moment. But again, significant that we are ending production in China. Is that something they set the tone for with some of their peers? We'll bring you the news as we get it right here on The Pulse. Now to one of the major stories from the overnight trade in the U.S. The U.S. FTC has sued Amazon in a long-anticipated antitrust case, accusing the e-commerce giant of monopolizing online marketplace services. In a complaint filed in federal court, the FTC and 17 states have accused Amazon of stifling competition and overcharging sellers. Take a listen.
These are a set of tactics, but ultimately Amazon has pursued them to deprive actual and potential competitors of the ability to gain the scale and momentum needed to effectively compete online. And having achieved and protected its monopoly power, our complaint details how Amazon is now exploiting that monopoly power in ways that harm customers.
And Amazon, in return, has promised to challenge the lawsuit, saying it's, quote, wrong on the facts as well as the law. Let's bring in Bloomberg's Valerie Teitel now. Valerie, all over this story. Look, this isn't the first time the FTC has tried to hit tech with, I think, a very low success rate. What are the odds this is something that actually tanks Amazon and the markets?
Well, look, the markets, at least analysts, are pushing back on the notion that this could lead to a breakup of Amazon. But you're correct, Kriti. This is the fourth lawsuit that the FTC has brought to Amazon just this year alone, and perhaps underscores the determination of the Biden administration to put the growing concentration of corporate power, especially big tech, at the heart of their economic policy. But this is a sweeping antitrust lawsuit. It's focusing on a very different cornerstone of monopoly law, which is prices for consumers. The previous lawsuits against Amazon from the FTC have focused on very narrow parts of their business, whether it was the Ring camera or the Alexa voice assistant. This one is sweeping, and it is, as you mentioned, long awaited. We knew that a lawsuit like this was in the works. Essentially, the FTC is arguing that Amazon blocks marketplace sellers from competing on price, keeping prices artificially high for consumers. And there was a statement from Khan, which I found very insightful. She claims that Amazon collects $1 of every $2 from sellers on the platform, effectively resulting in a 50% tax, 50% Amazon tax, which is then passed on to consumers. Now, the FTC didn't outline any specifics of the possible remedies in this case yet. If it wins the case, it could ask the judge to restructure the company, which could possibly end up in a divestiture of its logistic business. However, a lot of analysts on the street are pushing back on this notion, saying this is a years-long case that we have at our hands. It could take years to play out, and even Bloomberg Intelligence thinks if the FTC does win this case, they don't believe a structural remedy such as a breakup of the company would be the solution.
I'm surprised it took this long, frankly. I mean, we kind of knew this was, you said it, we've known this is coming for ages. Lena Khan wrote about it in her college thesis, both at Yale Law School. So when she was appointed, the expectation was that that would be the very first company she goes after. What are the odds here you actually see a breakup of Amazon?
Look, even if we do get to that point, it's not going to be, at least for a few years from now. That is what we're hearing from analysts across the street. They're really trying to water down the potential that Amazon could be broken up by this lawsuit, but that is the big risk, I guess, at case that Amazon does have to deal with. We did see shares yesterday in Amazon fall 4%, but the market was trading very, very weak yesterday when this headline did come out. It's interesting to see that in pre-market trade, we are rebounding somewhat. Amazon shares are up 0.25%. But however, the drag on tech shares and this I guess this umbrella of the FTC pursuing big tech is not a good thing when it comes to an outlook for the industry. And if we look at the S&P 500, the information technology sector specifically, Critty, it did enter a correction yesterday after these headlines. It is now down 10% since its peak.
I mean, it's a fascinating story, truly. And I also have to, I think, remind our global audience is that when you look at these antitrust cases, they're usually not immediately priced into the market. And I think Microsoft set that tone back in the 1990s for antitrust lawsuits. Bloomberg's Valerie Teitel joining us on this crucial story for the markets and for U.S. law. And speaking of, U.S. President Joe Biden has endorsed the United Auto Workers' demands for a major wage increase during a visit to a picket line in Detroit, telling strikers to, quote, stick with it. Joining me now, Bloomberg's Oliver Crook. Ollie, this is the first time a president has ever really joined a picket line since, I think, almost the mid-1900s. What did we actually hear from the president?
Yeah, it depends who you ask. Some say, really, this has never happened before. So really, this was kind of, we heard it from Trump, from Biden, I should say. Trump is a little bit later in the day. Some of the refrains that we've heard throughout this entire debate, which is basically the auto workers saved these big three during the crisis, and that they need to now benefit from the success that they've seen since then. Why don't we have a listen to Biden get a little bit of the atmosphere there in Michigan?
Wall Street didn't build the country. The middle class built the country. Unions built the middle class. That's a fact. So let's keep going. You deserve what you've earned, and you've earned a hell of a lot more than you're getting paid now.
And later on, he was asked by a journalist, should these guys be getting a 40% raise? And he says, yes, they should be able to negotiate for that. Then you also had Elon Musk on the sidelines on X saying that these 40% raises, these 32-hour weeks, of course, he does not use labor for that's unionized, so he does a much lower cost base, that these will put these GM, Ford, and Chrysler in the bankruptcy fast lane. So Trump is later today, he'll be speaking in Detroit, he'll probably be slamming Biden for the EV policy, saying that this is really the real threat to the auto sector. Sean Fain not really buying that. Sean Fain, the leader of the union, standing there alongside Biden, smiling, and he will not meet Trump. But really the question is not necessarily the leadership of the union, the constituency of the union, what will inspire them more? Is it going to be these questions about union power, or is it going to be some of the social and cultural issues that have really divided the United States?
I wonder if this is leading to an endorsement ahead of the 2024 election. Let's stick with the car theme, though, Ollie, and talk about the Bloomberg scoop on Tesla emerging as the focus of the EU's anti-subsidy probe. What do we know there?
That's right. So this was in the lead up to the probe. And of course, the EU is really going to do its homework before it launches something that has so many geopolitical ramifications. And what they have seemed to have found was that Tesla has benefited from a lot of these EV subsidies over in China. This is perhaps not a total shock, right? China has been trying to really lead the world on EVs. Tesla is a real sort of market leader in that. And Tesla's had also very unique treatment in China. It's one of the few companies, foreign companies, that completely owns its local operations there. But the question is, why does the EU care? And the answer is because a lot of the cars that are produced in China actually end up in Europe. About 100,000 of them so far this year. That's about 50% of the deliveries in Europe, which, of course, the irony being that the sort of biggest Chinese EV player that has deliveries in Europe is American, right? And so this supplements the output of the Tesla factory that's just outside of Berlin, a couple miles away from here. They've been trying to ramp that up. Perhaps they will do so with a bit more urgency given the geopolitical landscape.
All right, so we've covered the EU, we've covered China, we've even covered the United States. How does the UK fit into all of this, Ollie?
Right, so there's this debate about these tariffs that are supposed to come into force at the end of the year because of the rules of origin. And this is basically, where do the EV batteries come from? And unless you source them within the UK and the EU, you're going to be slapped with a tariff at the end of this year if you do not get an extension. So just to illustrate how far behind Europe is right now from China, China has 10 times the battery capacity of Europe. And by 2030, according to the IEA, China's still going to have 70% of the entire market. So by 2030, neither the US nor Europe is going to have as much battery capacity as China has today. And this is what the EU and the UK are negotiating today. Will they get an extension, basically, so that you don't have to worry about those tariffs going into the end of the year? The auto sector has lobbied for this. They have said, basically, why do you want to make us even less competitive in Europe?
I mean, it's a completely valid point. We'll see, of course, how it plays out and how much momentum it actually has. Bloomberg's Oliver Crook, thank you for joining the program, walking us through those crucial stories. Coming up, climate spending likely to be front and center of France's new budget, due to be unveiled today. We're going to bring you the details next. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Former U.S. House Speaker Nancy Pelosi has spoken out against the divisions in the U.S. In an interview with Bloomberg's Francine Lacqua, Pelosi also talks about standing up to Donald Trump, the biggest geopolitical threats, and what she's learned for more than 35 years in public office. Take a listen.
We have an aberration in our country right now, but hopefully that won't last too much longer. But nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Former U.S. House Speaker Nancy Pelosi there, and you can see the full interview with leaders with LACWA airing at 9:30 p.m. New York time tonight in the United States and 6:30 p.m. London time right here on Thursday. Now on to one of the biggest stories of the morning. The French government will present its budget today in a test of voter appetite for pouring public money into the climate transition, all while withdrawing support for inflation-hit households. The budget is also set to delay previously promised tax cuts. Bloomberg's Caroline Conan is all over the story, joining us this morning from Paris. Caroline, where do we see the increases? Where do we see the budget cuts?
So the French government has promised to find at least 16 billion euros in savings. A lot of these savings will actually come from the phasing out of the financial aid that households and companies have benefited since the energy crisis in order to help pay for their energy bills. But the government has also decided to delay some promised tax cuts on production, something that has angered the business lobbies in France, and also delay some tax cuts that he had promised for households for a couple of years. However, in terms of spending, an extra 7 billion euros will be dedicated to the green transition. So the green transition budget for next year will go from around 33 billion euros to around 40 billion euros. So quite a big chunk there for the budget. Of course, the margins of maneuver for the French government and for the President Macron are very limited because French growth is slowing down. The government expects 1.4% for next year. And of course, you have the high interest rates that are increasing the cost of financing debt. So the cost of financing debt in France will actually go from around 40 billion euros this year to more than 70 billion euros by 2027, which is the end of Macron's mandate.
I mean, there's some pretty lofty ambitions here. I mean, just the fact that we're talking about an increase from 7 billion euros to I think like 40 billion or something, it's enormous. He also presented part of that plan on Monday. How does that become a priority in the budget? How much support does he actually have to do that?
He does have, of course, some support from supporting the climate transition, but he knows he's walking on very thin ice because remember back in 2018, when he tried to introduce a carbon tax, that actually sparked the massive Yellow Vest movement and this big social unrest against the cost of living. So the government has to be very careful when it comes to taxes and spending on the green transition, which is why in this budget and in this green plan, they say we're not going to increase taxes. This is not how we're going to finance the green transition. So a lot of these 7 billion euros extra for next year will actually come from phasing out some fuel support for agriculture and construction sector. We'll see whether this angers these farmers and the construction sector. A lot of this money will go towards, of course, EV charging points, the production of EVs made in France. Macron wants 1 million of them made in France by 2027, but also some new regional trains around the big cities in France, and also solar, wind power, hydrogen. All this, of course, will be part of the green plan of Emmanuel Macron.
I mean, Europe has the advantage that it is actually economically incentivized to do that. That is not something the rest of the world shares when it comes to the green transition. Bloomberg's Caroline Conan all over that story. Thank you for joining us this morning. I want to stick with the continent and talk about the geopolitics in Spain. Spain's opposition leader, Alberto Núñez Feijóo, is facing a vote today in his bid to become prime minister. If the People's Party leader fails to get fellow lawmakers backing, he hands his opponent, Pedro Sanchez, a clear shot at forming a government. Joining us now for more, Bloomberg's Ben Sills all over that story. Ben, today is the first vote to elect the opposition leader. Things already aren't looking like they're going to be in his favor. Why even bother?
Well, I think that there's a question here of going through the motions, but also kind of respecting the political, it's almost like the etiquette. Feijóo came first in the election. He feels like he has a legitimate claim to be the next prime minister, and therefore to back that up, he needs to go and take the vote, even though he knows he hasn't got the support in the parliament to win it.
How does the Catalan pro-independence movement play into all of this? Of course, we know Spain has a lot of regional nationalism. Where does that factor in?
Well, the votes that will probably get Pedro Sánchez over the line to claim a third term will come from one of those Catalan separatist parties. He's cutting a deal with them to probably give them some kind of amnesty over that illegal referendum, which will allow their exiled leader to come back from Brussels. But more broadly, the Catalan issue has kind of roiled Spanish politics for the last 6, 7, probably 10 years, and it's really been one of the driving forces which has kind of broken down the old two-party duopoly that used to control the country.
I like that you phrased it as amnesty because, of course, we saw, I think, protests of something like 40,000 people or something in kind of contrary, I should say, to what Pedro Sánchez was trying to do with that amnesty at the core, political, of course. Talk to us about what the Spanish people and the press are making of all of this.
Well, they're pretty divided. On one side, you have the conservative right, Feijóo's People's Party, but also Vox, which is a kind of more extreme nationalist group who are extremely angry about this. They say that Sanchez was before and will be again an illegitimate prime minister. And then you have the more liberal side of society, which is relatively sympathetic to the Catalans, not necessarily in favor of independence, but does want to see this resolved in a more conciliatory fashion.
A lot to digest here, and of course, we're going to watch that very, very closely. Bloomberg's Ben Sills, thank you for joining us this morning. Coming up next on the program, we hear from the Pegasus Airlines CEO from the World Aviation Festival in Lisbon. That conversation next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We're bringing you a host of interviews from the World Aviation Festival today. Bloomberg's Guy Johnson spoke to the Pegasus Airlines CEO about jet orders, revenge travel, and the impact of those high fuel prices. Take a listen.
We see the demand. I mean, even during the COVID period, that 2020 and 2021, we received our delivery from Airbus 321 Neos. Yep. And this summer is the busiest summer we had ever had, because we had about 30% capacity increase compared to 2019, which was the last normal year. So this year we will be receiving 16 aircraft. Yep. This year, and going forward, we will have another 75 Airbus 321 Neos to be received. Now, the network is wide enough, extensive network in Europe, Middle East. We carry also connecting traffic because Istanbul is very well located. We have more than one base. The main hub is Istanbul, but then Antalya, Izmir, Ankara, other bases in Turkey. So we see the demand there for growth, for future growth.
Do you see demand slowing down? We've come out of the pandemic. Everybody wants to go on holiday, revenge travel. That is the phase that we've been in. Is that coming to an end?
It has come to an end. Technically and officially, you're very right. It has come to an end. That revenge travel has come to an end. But this doesn't mean that the demand is going down. The demand is strong. But last year, whatever we had put on the table, no matter the price, it was consumed. Yeah. This year, it is normalizing. I mean, customers are looking for affordable fares. Then they are checking the airfares to get the best, to find the best one. So that revenge travel has come to an end in this perspective.
So they were price insensitive, they are now price sensitive.
Like before COVID.
Okay, so we're back to normality there, which brings us on to the fuel conversation. Fuel prices, just been talking about it, rocketing higher. That obviously feeds through very quickly into the airline sector, depending on your hedging strategy. Does higher fuel mean higher fares?
The higher fuel, because the fuel is the main cost item of the airlines. Yeah. So if you cannot protect yourself at the end, it means so. However, airlines like Pegasus, for example, we do adopt a hedging strategy there. This year's around 45% of our fuel consumption is hedged, for example, and last year it's about 40% of our fuel consumption is again hedged. So it's a concern. And fuel price going forward is a concern.
Is demand strong enough that you can say to your passengers, you are going to take that cost?
Right now, we see the demand. I have no concern over the demand because September is strong. Yeah. We see an extended summer into October and November. So going forward, looking into the future, the demand is there.
Pegasus Airlines CEO Güliz Öztürk there with Bloomberg's Guy Johnson. Coming up later, we hear from IAG CEO Luis Gallego as well, joining us at about 11:45 a.m. London time. And the IATA Director General Willie Walsh joining us at 3:40 p.m. London time as well. And a quick reminder of our top story from Europe this hour. Italy seeking to turn Banca Paschi into the country's third largest bank by merging it with one of its peers. Markets not loving that story. You're seeing those shares down by about 4.3%. As, of course, we've learned that the government is holding informal talks with advisors. More developments to come. Stick with us. Up next, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York, setting you up for what you need to know as the U.S. traders come online. This is Bloomberg.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The dollar extends its winning streak while yields fall back from decade highs. Consumer confidence in the U.S. economy stalls. Markets on the edge, with the U.S. on track for an October 1 shutdown, despite some incremental progress on spending bills from lawmakers. And the Federal Trade Commission files a landmark lawsuit against Amazon, accusing it of monopolizing online marketplace services. Good morning. Confidence may be fraying in the consumer, but you can see this symbiotic relationship between the rolling over of yields and a pause for thought in the equity market. A little bit of green on the board. It's the first time you've seen that in 5 days in Europe. The question is, of course, you've got a correction going on in the tech sector, down 11% from the highs, down 7% from the highs on the S&P 500. These markets, you've got to be wary of calling any kind of turning point, but they are consolidating today. They're pausing for thought. There are imminent risks to be had. You can hear the vacuum of the money market funds roaring, sucking in $5.6 trillion this month alone. The outflows from Europe, Barclays say has hit a high point. It's overdone at this stage. Bottom of your screen, you've got the all-country world index. Lovely fact of the day, it's the biggest, longest losing streak since 2011. You're below the 200-day moving average. These things begin to kick in. And Amazon, of course, grappling with this landmark antitrust case, down 4% in the after hours last night. Amazon trading back up 0.25%. We'll talk more about that and tech as we go through the morning. Would you call a pause, Danny Berger?
I would call it a pause in everything except King Dollar. I mean, there's always got to be something that bucks the trend. All the assets I have up here, the cross-asset picture, is exactly what you're showing in stocks, Manus. But look at the euro weakening even further versus the dollar. It is trading below 106. Is it the weak data we got out of Europe? That credit crunch not going anywhere, alive and real. Bloomberg Intelligence pointing out that it means that the ECB will have to stop hiking. Crude, though, that returns to its gains after a pause yesterday. We're up 1%. Eurasia Group saying that OPEC Plus is going to have to continue those cuts into 2024 if they want to be able to keep oil prices climbing or at least prevent them from falling. Now, finally, here's the pause in yields in that climb higher year we're talking about. Manus 10-year yield, it's down by about 3.5 basis points, called about just under 4.5% under that figure again. We are steepening again today, but it's bull steepening finally, not kind of the dreaded bear steepening. But Manus, as we pause for thought over the changes to this market over the past week, here's a big glaring one. Now, this is the term premium as calculated by the New York Fed. Now, a lot of math goes behind this, so I'm not going to even attempt to really get into the nitty-gritty of it. But the term premium is above zero. It's above zero for the first time in 2 years, but Manus, over the past 7 years, this thing has been negative. In other words, we're finally at a point where investors are demanding more return for the risk of holding duration.
And to that point, I'm not going to try and get into the dirty math with you either. In terms of the discussion I had with one bond trader, swaps trader this morning, he said, look, you just got to think of this as being a world pre-QE, pre-QT, when there was term premium, a world that had a dirty bond market for many, many years, and here we are coming out the other side. You've got lots of mini depth charges in the market that we've identified yesterday, from government shutdown, politics, oil bumping higher, and with all of that, that imbues a new term premium in the bond market. The question we put to our guest, Octavia Morenzi, the co-founder and CEO of Immerse, is whether there's enough term premium to get him to step in and pick up a bit of duration. What does the return of term premium say to you, Octavia? And if you've got the math, good for you.
Well, I would say at this stage, we're seeing a pretty much inverted yield curve in the US. So the very short-dated US Treasury is looking really attractive at this stage. And to put money into the very long term, I think, is sort of a fool's errand. I mean, you have a tremendous amount of interest rate risk out there. I think the balance of the risks is that the Fed has to continue to increase interest rates. And so you're going to get hammered on that end of the yield curve if you're going out into long durations. So I would stay away from that and basically focus on the short end. And the returns that we're seeing on up to 6-month treasuries are now above 5%. That's really fantastic. You're basically getting 5% for doing absolutely nothing and taking absolutely no risk. So that's the end of the yield curve that I would want to be on, not way out on 10 years and 15 years and 30 years where it looks really risky.
So you still want to lock in that yield, that 5% yield. But Octavia, what is the risk? You have things like oil, for example, that fuel the short-term inflation pickup and the Fed hikes more, and then that undoes that front-end long trade.
Well, I think you're absolutely right. The oil is driving inflation further. The Fed is fairly optimistic about being able to stop its interest rate hikes and maybe even start to decline interest rates in 2024. I think that's going to recede further and further into the future. High energy prices, high oil prices are going to snake their way through the system, directly increasing inflation and indirectly increasing it as well. And the Fed's hand is going to be forced. They're going to have to carry on increasing interest rates, and that's going to be very, very bad for the long end in particular.
I like the way you say it's a fool's error to even pick up duration at the moment. You're right, the risk-free trade is 5.5%, give or take, in the money market funds in T-bills. How much further do you think the Fed is going to have to go? Jamie Dimon, the big story yesterday, flying a kite that, you know, maybe 7% might have to be put on the board. Could you even countenance something towards 6%? Do you think they may well have to push that high and that hard?
Well, I'd say a year ago, we were calling for interest rates to basically end up between 6 and 8% within 18 months. And so we're getting close to that. We're the spitting distance now of 6%, and I think it's going to carry on going. I think Jamie Dimon, I think he's not just flying up a sort of a balloon to see how people react to that. I think he's really afraid that the interest rates will go, the Fed funds rates will go up to 7%. And there's sort of a sense of foreboding, I think, in the US banking industry, that they've seen a tremendous run now over the course of the past 2 or 3 quarters with net interest margin just exploding and then making a lot of money off that. And basically that starts to contract. Eventually, depositors and people holding checking accounts and savings accounts are going to demand 5% on their holdings.
And we've seen that, right? We just had S&P data going out through the year of June. They fell for the first time for data going back to 1994. Octavia, we're going to get more into banks in just a little bit. but translate that to me and also the health of the consumer at this moment. Costco had earnings yesterday. They were not great. We had consumer confidence worse than expected. The latest Fed data, only the top 20% of the richest Americans still have pandemic savings. Is this consumer okay, Octavio?
Well, I guess the US consumer was kind of remarkable during the pandemic, where they were starting to save 20 or 30% of their income. Who knew that Americans could even do that? Because they tend to basically live from paycheck to paycheck. So now we're back to sort of pre-COVID levels where people sort of are feeling, I think, a bit safer than they were back then and saying, I can afford to spend the money again. So if you look at spending rates, if you look at how much is being spent on credit cards, it's quite healthy overall. So there's some foreboding in the market, in the banking industry, the consumer in general, but so far that really hasn't translated into firm numbers. Things seem to be holding up in terms of employment, in terms of default rates on loans, all those things seem to be okay at the moment.
Would you just bail on equity risk then, given the scenario you've just outlined to Danny and I, 6%, 7% rates, what does that do to equities?
I think it hammers them. I think it hammers equities and particular tech stocks. So those are going to, I think, see a bit of a rough ride in the coming months. So in the next 6 to 12 months, I expect to see
5% lower, 10% lower from here? We're already in a correction in tech.
I think easily 10%, 10 to 15% lower is entirely plausible. But who knows? It's also kind of a fool's errand to try and predict exactly where the market's going to go. But the pressure is going to be in that direction. 10, 15% correction, entirely plausible, I think.
Okay, Octavio, stay with us. You know you're not coming here without talking banks. We're not letting you get away that easy. Octavio Morenzi of Optimus sticking around. All right, coming up, President Biden's senior officials are staying behind in Michigan for further auto union talks. We're going to have more on the latest development from the strike still ahead. And there's no tailwind for global financial assets. That's the view from Allianz chief economist Ludovic Sabran. We're going to catch up with him later this hour. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of Hello World, I head to Los Angeles. Meet some robots. Then eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue.
UBS CEO Sergio Motti speaking exclusively to Bloomberg earlier this week on his trip to China. Octavio Morenzi is a keen follower of the bank's founder and CEO of Optimus, still with Danny and I. So Motti has a monster job to do and monster job cuts to deliver. The market at the moment on a price-to-book valuation is fairly robust for UBS. The other side of the story is SocGen on its knees. Would you buy UBS, and what is it that will re-accelerate the valuation of UBS? Is it the dividend, is it the buyback, or is it the announcement of the job cuts? Octavio.
I think it's basically the cost savings that Arbitrage is going to drive out of this merger with Credit Suisse. So he's basically said we're going to drive $10 billion reduction in costs, and that's going to be a result of merging with Credit Suisse. Now, that's going to come in all sorts of different areas and require a lot of job cuts. I mean, bear in mind that Credit Suisse, at its peak, had about 50,000 employees. What Arbitrage is talking about is basically cutting 50% of the cost of Credit Suisse out of the equation, which reduces costs per year about 20 billion. So, you know, back at the envelope calculation, that means 25,000 jobs are going to have to go. And that is a lot of blood on the streets. And I think that's going to be quite unpopular politically in Switzerland, because a lot of the cuts are going to have to come from the Swiss domestic market as well.
I mean, can they do that with that political pressure from a merger that was sanctioned and ushered in by the Swiss government? That surely won't look good on their part.
It's not going to look good, and that's going to be his challenge. It's going to be more a political challenge one than an operational one or a financial one. I mean, he can talk about job cuts of traders and investment bankers, and there people in the street are basically cheering on, say, great, I love it that those people are losing their jobs. When it's a bank teller in the local bank branch, they feel a lot differently about that. And of course, there's a lot of employees that they have in the Swiss market. And the overlap between Credit Suisse and UBS is the most extreme in the Swiss domestic market. I mean, every corner in the street in Zurich has a UBS branch on one corner, a Credit Suisse branch on the other. All those are going to have to go away, and that means a lot of job cuts. So it's going to be interesting to see how he navigates that. And it's going to be a political process, I think, more than anything else. That's the big challenge for him.
Well, of course, you know, he's got form on this. He started out with the integration many, many years ago, and he set a very high level of job cuts, and it didn't ever end up being there. Let's shift gears. We've got a new CEO over at SocGen. Good luck to Arbitrage in terms of delivering the buyback and the dividend and the restructuring. But over at SocGen, we've got Slawomir Grupa. I mean, to say the market was underwhelmed, it tanked by 12% on the day. It was all a bit vague. What does he need to do to reinvigorate the narrative that he is the leader that SocGen needs? The price-to-book value is on its knees at less than 0.3. I mean, this is a bank that's trashed in valuation and trashed in confidence.
Well, first let me say that in the French banking market in general, we've seen this compression in net interest margin already happen. And that's in large part because the French government actually regulates the interest rates on savings accounts, at least for certain classes of them. So the French government has basically said, you shall pay 3%, 4%, and 6% on these savings accounts. Yeah. And as a result, that's compressed, and that's, of course, hitting SocGen and the other French banks fairly well. I mean, Krupa's announcement last week, where he laid out his grand strategy to basically drive costs out and increase return, really fell flat because it was very long on platitudes and very, very short on any sort of detail. He basically said, we're going to drive operational efficiency, we're going to be client-focused, we're going to do everything we need for the shareholders, without really laying out how it is going to happen. The only concrete things he basically said is that they're going to reduce lending into the gas and oil sector, and that there was a big, strong ESG component to his strategy overall. But that's only a way to basically reduce your earnings, and that's the only thing that he really laid out in any sort of detail. So I think he has to go back to the drawing board, he has to come up with a new strategy, and he has to lay out exactly how he's going to achieve these cuts, where it's going to come from, rather than these sort of general platitudes. He needs some concrete steps, and that's what he has to do. He needs a really defined strategy, not just vague statements.
Another banking CEO that's come under a lot of pressure, maybe a lot of pressure is an understatement, is, I think you know where I'm going with this, is David Solomon. I mean, there clearly are internal grumblings to get the media story after media story that we've seen. At what point, and maybe we're already there, does this become a priority for the board, that they need to figure something out?
I think the board does not care what David Solomon, how he sounds, and is he too gruff, and does he not send people Christmas cards and birthday congratulations at the same time. I think they care basically about the returns of the bank. And their things have been disappointing. I mean, Goldman Sachs used to be the high performer, the top flyer, and it hasn't been for some time now. So that's really what the board is going to be looking at. As long as those numbers are right, it's going to be fine. All this background about people don't like him and he's unpopular and he's a DJ on the side. By the way, I listen to his music. I'm not really sure that I'm well positioned to judge it, but it sounds okay. You know, it sounds possible.
A glowing review there from Octavio. Manus, have you heard D-Sol?
I've got this vision of Octavio sort of having a wonderful summer in the Hamptons, you know, just sort of partying away. Octavio, let's. The view is that from Mike Mayo, Danny and I would cover this last week. The view is from Mike Mayo that he will be there in the medium term. My question question to you is this: what more does he need to do to survive the medium term? He's already paring back the sort of ill-fated consumer trade. What more needs to be done to ensure the medium term?
Well, here's a real problem in the sense that trading and investment banking have done badly everywhere, at all banks, and Goldman Sachs just happens to be more exposed to that. Now, in the consumer side, he's basically pulling back now. That wasn't his idea originally. That basically started before him, though he pushed it very, very hard, and maybe harder than he should have. He also led to a big expansion in jobs at Goldman Sachs in 2020, in 2021, that he's now having to roll back. So he's going to have to show results, I think. He's going to have to show a strong return on equity, a big increase in returns. Otherwise, the board is going to lose patience. And I know everyone says that the board is fully behind him. Well, the board is always fully behind their CEO until they're not. And that time runs out very, very quickly when it happens. So I think there is a risk there for him, for Solomon, that basically the board at some stage, after the next quarter or another 2 quarters of earnings like this, basically says we need to change horse now. So I would give him 2 more quarters at most, unless he has a big turnaround in earnings. And his DJing and his gruff manner and his unpleasantness, I think, is all irrelevant to the whole story.
Octavio, we are also in this period, you mentioned SocGen, where we've had a lot of banking strategy updates from Santander to Citi too. When you're looking through these updates, how much do you see and do you not see about grappling with the new normal of 5.5% rates?
I see actually very little of it. I mean, so we are seeing that coming. We're seeing basically the investment banking and trading side not doing well. There's little being said about that. There's some job cuts there, but not as intense as you might expect. And so we're seeing sort of some tweaking there, but it's not really directly addressing the interest rate problem because, frankly, there's not much you can do about it. I mean, earlier on you had the CEO of an airline on talking about the price of kerosene. There's just not much you can do about it. I mean, if the price of kerosene goes up, you as an airline have to buy kerosene. As a bank, you have to borrow money. And if interest rates go up, then you have to basically bite the bullet. But so Citibank and Santander, both of them are sort of pursuing a slightly similar restructuring, actually a very similar restructuring, where they're saying we're going to be less regionally focused and more product focused. Now, I don't know exactly what that means. Big banks always have these kind of matrix organizations where you report to the country head and to the product head, and now they're saying we're going to get rid of the countryside. But that's something they could have done, maybe should have done anyway, regardless of interest rates.
Octavio, I'm afraid we're going to have to leave it there, but let me say this. If you ever decide to DJ on the side, Manus and I will absolutely come to your shows. We'll be in the front row cheering you on. He's got good taste in music, Manus. That's Octavio Morenzi. Thanks so much for joining from Immerse. All right, coming up, we're going to be getting the latest on the UAW negotiations as the U.S. government shutdowns looms. That's next.
Quick check on markets for you this Wednesday morning. You've got a turnaround in the S&P 500. Of course, we're back in a correction on the NASDAQ. The dollar is at a 9-month high, up for 6 days in a row, the longest winning streak in a number of years. Yields just roll ever so slightly below 4.5%, and crude pops 1.3%. Inventories drop at Cushing. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave
In China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Welcome back to Bloomberg Brief. I'm Danny Berger in London. Manish Krani is in New York. Senate Democrat and Republican leaders have agreed on a plan to keep the U.S. government open through mid-November and provide $6 billion in assistance to Ukraine. The stopgap measure to avert an October 1st shutdown has to overcome gridlock, though, in the Republican-controlled House. Speaker Kevin McCarthy could face being ousted by conservative hardliners if he allows it to come to a vote, Manis.
At the same time, you got President Biden endorsing the United Auto Workers' demand for major wage increases during a visit to the picket line in Michigan. Let's take a listen.
You guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices, gave up a lot, and the companies were in trouble. But now they're doing incredibly well. And guess what? You should be doing incredibly well, too.
Incredibly well. What is the definition of that? It is day 12 of the strike. Oliver Crook is tracking every twist and turn. Oliver, what's been the reaction to this historic visit by a sitting president to the picket lines? He wants to go down in history as a president of the people, as a president of the workers, is my take.
That's right. Well, there's two dimensions to this. Let's talk first about how it bears on the negotiations. What we didn't hear in that soundbite is afterwards he was asked by a journalist, do you think that these guys should be getting a 40% raise? And he said, yes, they should be able to be bargaining for that. And this is a kind of figure that Ford said would bankrupt the company. And on the sidelines, you have Elon Musk tweeting saying they want a 40% raise, they want a 32-hour work week, sure way to drive GM, Ford, and Chrysler bankrupt in the fast lane. The context to that, obviously, is that Tesla does not use union labor. This is the competition now, much lower labor costs. From the election point of view, Sean Fain, was standing there, standing next to Biden, smiling. He is still not endorsed. Again, these are all critical votes for both Trump and for Biden.
Well, on that point, Trump is heading to Detroit today. What are we expecting from him?
That's right. It's sort of counter-programming for the second Republican debate that's supposed to kick off at 9 p.m. Eastern time today. And he's going to go down there. The question is, how is he going to address these auto workers, and what is he going to say about the auto industry? His main point probably will be that the Biden EV push, he says, which is a hoax and all these sorts of things, is really the issue that is defining for the auto industry and really what's destroying it. As far as the auto industry is concerned, how will they receive that? The leadership, Sean Fain, yesterday saying, I don't think the man has any bit of care about what our workers stand for, what the working class stands for. He will not meet Trump while he's over there. And then the question is, though, about the constituency. Yes, the union leadership may feel that way, but will the constituency, will they vote along union lines, or will they be more interested in some of the social and cultural issues that have really divided the United States?
Yeah. Ollie, thanks so much. Oliver Crook there covering the latest from the UAW. Everyone's going to Detroit these days. It was Jamie Dimon and now the president and the former president. All right, coming up, we're going to get back to this economy. Ludovic Sabran from Allianz sees no tailwind for global financial assets in the coming years. Going to more on that next on Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Craney in New York.
And I'm Danny Berger in London. Here's what you need to know. The dollar extends its winning streak while yields fall back from decade highs as confidence in the U.S. economy stalls. Markets are on edge with the U.S. on track for an October 1st shutdown, despite some incremental progress on spending bills from lawmakers. And the Federal Trade Commission files a landmark lawsuit against Amazon, accusing it of monopolizing online marketplace services. Now, the dollar continues to weaken. We're in this moment where the euro is at its lowest, at its weakest level since March, since during the SVB crisis, since the collapse of Credit Suisse. Euro, that's trading at under 106 versus the U.S. dollar. So we continue to see the dominance of the dollar, but virtually everywhere else, and I know, Manus, you'll get into the equity part of this, it is a pause of the past week, a pause, a rethink of this adjustment to a higher for longer regime. Crude, that continues its move higher. It's up a 1 1/3%. We've seen that impact coming from OPEC Plus. It's really bucking that overall demand concern. On that note, Eurasia says that OPEC Plus will need to hold on to those cuts and keep them coming into 2024 if they want to put that floor underneath oil prices. And here you go, U.S. 10-year yields, those are lower by, let's call it 4 basis points. Again, this is a pause, Manus. We're now back under the 4.5% marker.
And it's that roll down in the yields, Danny, that gives a little bit of a pause for thought in the equity market and sort of stymies the implosion that you had. S&P and NASDAQ down 1.5% yesterday. They put in a little bit of a more level ground this morning. So you've got the S&P 500 up 0.4%, and the NASDAQ up a similar amount. What you've got to consider here is that the tech sector, reflected in the NASDAQ, is down 11%. It's in a correction territory. Is that a reason, as ICAP said, which is on these drops, is where they want to come in and scoop up opportunities in mega tech? The flow out, we saw it in the Bank of America flow show in Europe, 26, 27 weeks in a row. Barclays say the European stock outflows are overdone. But what you have here is this pause for thought as the yields roll down. We just had a conversation with Optimus, with Octavio there, and he made the point, actually, you should get ready for 6% or 7% rates. It is a very real possibility, and in that context, you can expect a further drop of 10 to 15% in equities. Bottom of your screen, you've got the all-world index, and we've got the longest losing streak going back to 2011. Yes, it's below its 200-day moving average. It's back to flat at the moment. Keep an eye on Amazon. Let's see how it trades in the day. You've got this landmark lawsuit, antitrust lawsuit, a monopolist that stifles the competition. We'll talk about that through the next 30 minutes. Amazon was down 4% after the close yesterday evening. We'll check out how it trades for the morning. Danny.
Yeah, Manus, I gotta say, you know, listening to Octavio talk about a 10% drawdown possible, I gotta think how awkward the timing is. We've just come out of this period where strategists, sell-side strategists on stocks have been so caught off by the gains. Virtually everyone just upgraded their outlook, but now we're in this period where, hey, potentially they can't last if we're having this rethink on duration.
Well, the whole point about duration is, and again, we brought this up, you've got this term premium back in the bond market, back in the green, and for him, that is not enough to scoop up bonds on duration. He wants to be at the short end of the curve. And by the way, you're going to earn 5.5%, Danny, on your equities. Sorry, you're now going to earn 5.5% in money market funds, which are just sucking in the money, $5.5 trillion this month, relative to the dividend yield in equities. So there's a battle royal between risk-free money and pure volatility play in equities. Danny, good morning from New York.
Good morning from London, Manus. On that note, let's shift to Europe. And, well, I guess not to London, to everywhere in Europe, but London, and focus on the ECB, because they've just published credit data about an hour or so ago from the ECB showing the biggest slump in that credit data and demand since the euro crisis. Despite that, we heard from ECB Governing Council member Robert Holtzman speaking to the team yesterday, saying he can't rule out another rate hike. Take a listen.
And as a result, we cannot say for sure now we have reached the peak and no more increase. The reason is that the inflationary pressure is still on. And just these recent days, we have seen how much energy prices have surprised us.
Joining us now is Ludovic Chabon, Allianz chief economist. Ludo, even if there is more inflation to come down the pipeline, does the ECB risk an accident at this point if they continue to hike with the deteriorating data we've seen?
For sure, and especially because, you know, if the ECB now gets its intel from the higher energy prices, we're getting it wrong. You know, it's not up to the ECB to hike to lower the price at the pump, right? We have other issues and certainly other policies in our toolbox to deal with that. I think a further hike would be really pushing it over the fence. The big question now is how long can we stay at these high levels of interest rates? Because already we see the deteriorating credit data, and we already see that the housing market is also under a bit of duress, right? So I think the big question now is whether they're going to pivot at all in 24. And I think this is, you know, a lot of that is in the hands of the Fed. You just mentioned some people are now repositioning themselves in a much more bearish environment, so much higher for much longer. I think that's going to drive also the ECB. They don't want to be the only one to pause, because that would completely spook markets, that the ECB would have thrown the towel a bit too early. So that's the risk here. What the Fed does will be a much bigger driver than the energy prices in the ECB objective function and monetary policy function. We have the ECB staying put for now, but we still have one hike for the Fed. So that's going to be something that will create a bit more of a transatlantic spread, if I will.
Ludwig, good morning. Yeah, I mean, we saw the consequence of the Swiss doing that sort of unexpected pause. Look at the Swiss franc. I mean, talk about taking a pasting, the longest run of losses in 50 years, and the euro is under pressure. But let's go back to Holtzman. Okay.
I'm surprised the Bank of England didn't have the same reaction, because they paused far too early. The UK is one of the few economies that actually has a wage price spiral in the making right now. So you're right. Currencies are going to be the jury, and they're going to be the yardstick against which we're going to be worried, especially because the dollar is still very strong.
Okay, let's push you a little bit further then. Let's bang these out then. Okay, on sterling, you're surprised by their action, but sterling has taken the heat. So how much lower does sterling go? Lots of people are calling down to 118. Where do you think the pressure in sterling is? First of all, let's take it there.
I think they can go down as much as 10 to 15% more if you know, the Bank of England doesn't hike again before the end of the year.
And Ludo, you talk in your notes about the everything slump, about all asset prices falling in 2022. Have we grappled with the new normal of a lower return world?
Well, I think one thing is sure is that, you know, the end of, you know, real equal nominals world is behind. I mean, we see now that anybody is deciding on where they put their savings based on real returns. And of course, there's been a big move from bank deposits to the bond market, but the bond market is super volatile because everybody is tracking whatever the central banks are doing. And you see the central bank's data dependency is a nightmare for market participants because we never really know if they pause for real or if it's a dovish pause, a hawkish hike, whatnot. So you see that this is creating a lot more volatility on the bond market, which is one of the securities that people actually were rushing into. And 2022 was a one every 30-year type of event, nowhere to hide. So 23 looks much better, but it doesn't look as good as one would have expected. And you mentioned, in your introduction remarks, the risky assets. Equity markets have been super, super resilient. Credit spreads have also been super, super narrow for their own good. So of course there is a risk that there is a repricing on that front. And so we're looking, especially at the weaker links, the peripherals, the high yield, there is still, a need for, quality for the investment. So the world for investors is not easy. We know the world for net lenders is not easy, but the world for net savers is not easy either.
Ludwig, I had the point at the start of the show, which is I can now get an ETF of a batch of T-bills or short end rates that give me 5.5% in dollars. If I am a more mature investor, let's say, why not take 5.5% until I get all of these issues off the agenda in the back quarter? Surely I'm driven more to the short end of the curve at 5.5% than I am to high volatility equity. I mean, is that how I should look at risk going to the end of this year and the beginning of next year? It sounds to me like you're talking about a very risk-off 2024 environment.
Of course. 2024 is the ultra-long year. The polarization on the U.S. elections, the wait-and-see mode on investment and consumption for corporates and consumer is going to create a natural risk-off mode. You're right. Everybody is pushed to the shorter end of the curve, but this is also where the bulk of the volatility stays. So it's great to have an ETF, but you need to stay put and to hold to maturity. At least, don't move too much.
Yeah, I tried that a few times in 1994. It didn't go so well. It was one of the largest margin calls that I ever had. Take me back to 1994. Thank you, but no.
Yeah. There is a clear parallel with 1994 on the hiking cycle, by the way, because we don't know if they're going to give back.
Yeah, we're a step away of Manus reinforcing that he's going to take forever to retire with those sorts of moves.
Stay on, Manny. Stay on.
Yeah, agreed, Ludo. Okay, look. So it's these front end cash-like instruments that are getting all this attention. But weren't these the money market funds that melted down in the pandemic and caused the Fed to step in? If all of a sudden we're talking about more money flooding into it, should we not be concerned right now?
Yeah, look, we had a bit of a scary March, right? So I think we are not out of the woods yet. There is, of course, these liquidity pressures, but market liquidity, because central banks are withdrawing fast, and so there is a question on whether there is a rebound in U.S., especially provided liquidity in 24. I believe yes, and there is the funding liquidity. Just talked about the risk of a credit crunch in Europe. So yes, money market funds is a huge vortex, and it's great for the short-term returns somehow because it's stable in an environment that is not stable, but that creates a lot of side effects or negative externalities on the other products, and especially for banks it's a big question because there are banks and there are other financial providers that should really look at the leverage and that should really look at the liquidity position with eyes of a hawks. I've been saying that since March. The liquidity crisis is not over. You need to watch.
So do you think that we face another SVB-like moment briefly before we move on to China? We've got to squeeze China in for the end. Well, I'm not saying that we're going to have another bank implosion, but are you deeply concerned about a major financial tail risk on the flight of deposits?
Yes, I am.
Okay. I love this line. An undisputed hegemon, H-E-G-E-M.
Hegemony?
Thank you. Hegemon in finance is France and Japan have lost. I know. You see, it's the Irish in me. It's these long words.
The Irish, yeah.
Europe and Japan have lost some of their weight in the composition of the global financial markets. China's share grew slightly. When I look at everything that's been written about China, written about housing, watching images of massive tower blocks being blown up, when I look at the incremental policy responses, I'm not inspired. Are you?
I'm not. China is very cheap. Chinese equity are very cheap, but if you believe in a Cold War II, you don't go much further in terms of positioning. You're right to mention the real estate crisis. You have to think Spain 2009. You have to think Japan mid-90s. It's going to take some time for China to be attractive again because they have a very depressed saver. You know, people have lost all of their pension, you know, in Evergrande crisis and the likes, right? So I think it's going to take time, but I wouldn't, underappreciate the fact that China is very innovative when it comes to policy determination, and they're ready to cut a couple more times the RRR. They're ready to put more fiscal subsidies without recreating a bubble. So stay tuned. It's not going to be as bad as the market sentiment is pricing in right now, but personally, I would be very cautious with Chinese holdings. I think it's still, you know, there's going to be some flaring up in the US-China rivalry, and it's going to be on the capital account. It's not going to be only on the trade account.
Ludo, stay tuned, but how long do I have to wait at this point? Bloomberg Intelligence had a great headline out saying, not a bazooka, but many pistols. How long do I have to wait until the many pistols result in sustained growth from China?
I think my expectation is that they're going to do a big move on consumption like they did with the EV reduced VAT back in 2016. The problem is that he needs first to align the ducks, right? And the problem here is China doesn't want to create another bubble because that would be really detrimental to any form of growth. So they need to reposition a lot of the public investment and the policy mix, including the cheap lending, to these, you know, tech environments. So climate tech, maybe, you know, tech at large, and certainly also the manufacturing. I think you're going to have to wait at least another 6 months because there is some division on where to stand. And they're going to also watch what's happening in the US election. So it could be as much as a year. But I think they're going to make some moves by the end of the year. And so we're going to have a bit more forward visibility, I would say, by the beginning of 2024.
I was going to say 6 months a year. I was actually expecting you to say longer. That'll go by in no time. What time is meaningless at this moment. Hey, Ludovic, we're out of time here.
Lending mode. Oh, sorry. A lot to say on China.
See? Oh, Ludovic. All right, come back on. You deserve another go. Ludovic Sabran of Allianz, thank you so much for joining us today. We'll hopefully see you again soon. Now, coming up, oil extends gains, hitting U.S. consumer confidence amid higher costs and excessive rate hikes. We're going to have more on that for you next. This is Bloomberg.
Jeff Bezos realized you could sell anything on the internet.
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Brief. You're looking live at the principal room. Coming up later today, an interview with Bob Michael, J.P. Morgan head of global fixed income, 7:30 a.m. in New York. That's 12:30 p.m. in London. This is Bloomberg.
So oil is marching higher this morning, resuming its rally. We're trying to grapple with how tight this market is for the back quarter. We're up 30% in the third quarter, up 36% since the June lows. There is unanimity, some would say, in the OPEC Plus family. What does it mean for prices going into the back quarter? Let's get to Will Kennedy. He is our managing editor for Energy. Will, I mean, look, to a certain extent, we've already got the message from OPEC Plus about the additional unilateral cuts. Is that what's squeezing the market higher, Will, or is the market front-running a bottoming out in China? Good morning.
Morning, Manus. Great to see you. I think it's still the OPEC cuts that are really taking hold of this market. It is constraining supply. There is less crude getting to the market than people have expected, and I think the global energy system, the global oil system, is stretched a little bit thin right now. But what we're seeing, I think, is a battle, as you allude to, between that tighter supply and how the global economy and the Chinese economy pans out in the rest of this year and into next year. And I think people are trying to find the price where oil demand reflects the economy at a time of constrained supply.
If we do get even lessened demand, a recession, what have you, is OPEC Plus, is Saudi and Russia in a position where they can continue to cut to put a floor under prices?
I'm not sure that Saudi will want to cut production much further than here if it can avoid it. Its production at about 9 billion barrels a day is very low by historical standards and leaves it with a considerable amount of spare capacity. So I'm not sure that that's a terribly attractive proposition. Of course, they have the option to extend their current cuts further into next year. And next year, a lot will depend on what other parts of the world do, how far shale slows, whether that can continue to grow, whether there's more oil from Venezuela, whether Iran continues its renaissance. I think a lot of people are now turning towards balances for next year, and that, as always, interplay between supply and demand. And some people are saying that, in fact, the market may not look as tight next year. So that, again, is feeding into the price today, because the market looks very tight right now, but some people are questioning whether that tightness remains into 2024.
Well, of course, you may get more supply from the likes of Iran and the Fragile Five. And Halima Croft reminds us all about Vladimir Putin and the potential re-weaponization of Russian crude flows. Will, thank you very much. Will Kennedy there with the very latest on the oil market. There's what Halima had to say about the market. Moscow may reduce some of the complacency that had crept into the market, but more on that oil market a little bit later on. Coming up on the show, we're going to take a look at some of the market-moving events for your trading day ahead. I thought we'd just check in on the currencies with you. The dollar, the musculature of the dollar is pretty flexy. It's up for 6 days in a row, 2023 highs. You're looking at the yuan, the dollar rising, the yuan lower. We did have a stronger fixing and a bit of verbal intervention on that. The euro at the bottom of your screen is down 0.1%. As you can see, a credit data slump it is really, really gripping Europe. The Fear and Greed Index hits the most bearish in 6 weeks. Euro dollar trades at 105.58 on Bloomberg from New York. Good morning.
ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. We're going to be getting U.S. durable good orders. They're likely to continue to signal tepid business investment outside of semis. That data will hit at 8:30 a.m. Eastern. Now, at the same time, we're also going to be having Micron reporting earnings. That's going to happen after the U.S. market close. Their investors are looking for any signs of recovery. There's been a lot of demand and excitement around chips. Can they keep it going? And then the second Republican presidential debate will be at 9 p.m. Eastern. Former president and current frontrunner Donald Trump plans to again skip the event. But of course, Manus, he will be heading to Detroit. He's going to be speaking there. President Biden was just there, too. So that's kind of the main event for him.
It is indeed. We saw Biden on the picket lines yesterday, so it's head-to-head on that front. We've got the story on Amazon, haven't we? The U.S. Federal Trade Commission suing Amazon. It's a long-anticipated antitrust case, accusing the e-commerce giant of monopolizing online marketplace services. In the complaint, it was filed in the federal court. The FTC and 17 states accuse Amazon of stifling competition and overcharging sellers.
These are a set of tactics, but ultimately Amazon has pursued them to deprive actual and potential competitors of the ability to gain the scale and momentum needed to effectively compete online. And having achieved and protected its monopoly power, our complaint details how Amazon is now exploiting that monopoly power in ways that harm customers.
Joining us now is Tom McKenzie. Tom, good to see you. Look, what is this case about? The accusation is sellers are paying $1 of every $2 to Amazon, a monopolist that stifles competition. What's the end game?
Well, look, this is the fourth straight suit from this FTC chair, Lina Khan. And look, she was pretty unapologetic in her critique of Amazon, as you heard there, saying, look, this is a monopolistic company and that sellers, but also buyers, you and I, are paying more as a result. So she's accusing Amazon, for example, of compelling sellers on the marketplace, forcing them to use their logistics and shipping parts of their business, also punishing them if they put their prices down on competing websites. Interesting as well in this suit, saying that Amazon actually interfered with the investigation by, for example, using Signal to hide some of the information that the FTC was trying to get their hands on. Amazon, importantly, saying they're going to challenge this, saying that it is wrong, this case, on the facts and the law.
Tom, we're going to have to leave it there, unfortunately. Thank you for the latest on Amazon. Taking a bath yesterday. That is Bloomberg's Tom McKenzie. Manus, we didn't have time to talk with Tom about it, but $90 billion valuation. That's what the Journal is reporting on OpenAI. That is a nice chunk of change.
It is, and that's going to be a private sale, we understand. I just wonder who's going to pick up a portion of that. Danny, good to see you this morning. We didn't get to celebrate you being made British. I'm going to hold that over for tomorrow.
Next time.
That's it for Bloomberg.
I'm even dressed
Surveillance.
patriotically.
Surveillance is up next. strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
What's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market.
There's some recognition by the Fed that if you tighten financial conditions much more, you're going to do real damage to the economy.
The Fed might hold here for a while, but it's very difficult to see why they'd want to go a lot higher from here.
Fed's retaining its optionality. It's not saying we're definitively moving higher, and it's certainly not saying 7%.
It's just hard to see what the positive catalyst is for markets today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
3-month lows in the equity market, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive this morning and trying to bounce up by 1/3%. That has not been the story of the last 24 hours. Yields up, stocks down. In the FX market, that's where the attention should be right now. TK, euro, dollar, 105, dollar yen, pushing 150.
Walked in and looked at the terminal off the cell phone, John, and you know, you go wow when you see a number move. I did a hat trick of wows. It's wow, wow, wow. It is Wow Wednesday. Across assets, we're going to be on this all morning long. Where do I begin? I begin with a real yield and the effect on the FX market out to 2.22%. John, I never thought I would see this quickly.
Lisa, things are getting restrictive and it's starting to bite.
It's starting to bite, which is a question of, are people getting a little over their skis here? There was an essay yesterday by Neil Kashkari, a Minneapolis Fed president, and he talked about two outcomes, either a soft landing or inflation continuing to accelerate hotter than they expect and them having to raise rates further. Where was the base case of a consumer that was running out of money and the potential for a recession? It seems to be off the table in some of the expectations, even as we see signs of true weakness.
Credit to Neil, who I think nailed it at the start of the year. Nailed it in terms of what the objective of this Federal Reserve is and what they'd need to do, TK, get rates up and then sit there for a while. And I think we're at that point now in the last month where we're starting to fully internalize this high for longer message.
Yeah.
TK, do you think we've fully discounted that now?
Oh, no. This is a process ongoing, and again, you can see it across FX and into the bond market. But, John, I'm going to shift from the liquidity, the fungibility of our world over to tangible assets. Dare I say real estate, and with our guest, Chris Verone, to start off, that's right where I'm going.
Looking forward to it. Chris around the table with us. Let's start with the price action. Equity futures on the S&P 500. As I said, trying to bounce by about 1/3% on the S&P after another tough day of losses for the equity market bulls. In the bond market, yields through 450 and back down again. Down 3 basis points this morning to 449. And that's that dollar strength for you, Lisa. The euro against the dollar, 105.61.
It's just amazing. Dollar strength has been one constant no matter what happens in the rest of markets. What I'm watching today, 12 noon, afternoon. Bank of America Chief Executive Officer Brian Moynihan speaking at the Economic Club of New York. I think it takes on a renewed importance simply because we've heard from a series of bank CEOs, and they all lean into this stronger for longer kind of story, right? We were hearing that from David Solomon. We were hearing that also from Jamie Dimon. Do we hear the same from Moynihan? Aftermarket, Micron is reporting earnings. This, again, I think the earnings are really going to be what could potentially be the most interesting data points, simply because you are starting to see weakness. We saw that in Costco yesterday. Do we see that in the semiconductor space as well? And at 9 p.m., the second debate of the Republican presidential candidates. It's airing on Fox. It's happening at the Ronald Reagan Presidential Library in Simi Valley, California. Who is not going to be there is the former President Donald Trump, who I don't know if he'll be joining the picket line, but he will be in Detroit with a follow-up act to President Biden yesterday. I wonder how much he's going to discuss electric vehicles and lean into some of the industrial policy. Very curious to see how that plays out.
Is he invited to the picket line?
I don't think so, no.
Okay.
It has been pretty, a little bit more frosty between the UAW and the former president.
Elaine Carmark was with us yesterday, the presidential historian, and she was riveting on her language on this. And off camera, she was really heated about should a president pick a side. And my point is, I don't think anybody out there is picking capitalism, job formation, investment in cash, the automakers trying to get to the future. It's a pretty lonely group.
He didn't have a choice, did he, TK? Based on the fact that he came out and said, I'm the most pro-union president in the history of this country, where else is he going to be, other than the picket line?
You know, I'll leave it to Greg Giroux, our expert on this, but the answer is there's X number of states, let's say 10 states that matter. Michigan's clearly one of them.
Big time.
And all this is about is the electoral votes and the closeness of that race the last two elections.
AMH coming up a little bit later this morning. Look out for that conversation down in Washington. As we said, around a table with us here in New York, I'm pleased to say Chris Verone, partner and head of technical and macro strategy over at Strategas, a bad company. Chris, good morning to you.
It's great to be here. Thanks, John.
We've tried to frame this the following way over the last few weeks, whether this move in the bond market is a reflection of resilience, an extension of the cycle, or a recipe for the end of it. Based on the moves in consumer discretionary, is it the latter and not the former?
I think it's the latter, and I think one of the big shifts over the last, let's say, 4 or 5 weeks as bond yields have made this last leg higher is that it's no longer being accompanied with cyclical leadership. You know, if you think about most of the year, it was bond yields up, but cyclicals over defensives. That changed in about mid-July when we began to really see the weakness in discretionary. We began to see some softness in industrials. It first really began in Europe. If you look at the European luxury stocks or European discretionary, that has now spread here. So I think you have to ask the question, is this last move up in yields the signal that we're end of cycle? And I suspect it probably is.
So is that a signal to buy, given this move we've seen in yields? By the long end?
You know, it's funny, we've thought about this a lot. You know, most in this business have spent their whole career waiting for bond yields to go up. And now it's finally happened, and all people are clamoring to do is to buy bonds. I think it's too early. Just a pure technical read of the charts gets me something like 510, 520 on 10s. I don't know if we get there or not, but we've had one mantra all year. The trend in yield is up until the market suggests otherwise, and the market has not suggested otherwise here yet.
Katie Kaminsky at Alpha Simplex, wonderful on trend-based technical analysis, and I took her head off yesterday. I totally agree with you. We can go blah, blah, blah on the show, but the technicals of the 10-year yield now are higher yield, and we can bore, you know, we'll do it off camera, bore ourselves with that. I want to go to the real yield, 2.22%. I modeled that months and months ago, and I'm shocked at how suddenly we got here. Tell me about the suddenly of the yield move we're seeing.
You know, I think what's interesting about this business is one of the real constants is the surprises tend to be in the direction of the trend. And the trend in yields is up, so I don't think it should be a particularly big surprise that they've gone up. And when I look at the real yield, I think it's a reminder that investors are going to demand a positive real yield. Historically, the last 75 years, U.S. 10-year yields have traded 200 basis points above headline CPI. So even if you're in the very optimistic inflation camp, let's say 2.75 or 3%, you can certainly justify nominal 10-year yields of around 5. That is not even remotely historically unusual.
Before we went live, you and I talked about the REIT sector. Yeah. To me, there's all this talk, you know, it's a market talk and that. Forget about it. The real yield is about tangible assets like real estate. As an example, is it going to be an implosion of the REIT industry as we've seen from the 70s on?
Well, I think the other lesson of trend following, Tom, is in periods of stress, the weak act the weakest. right? So what made new lows yesterday? The S&P Real Estate Index. What made new relative lows yesterday? The REITs as well. So I don't think we should be surprised by the price action if we let the trend dictate how we position. And when I look across all the sectors here, look at the difference between something like REITs or discretionary or even tech, which internally, while they may be vaunted, internally they're very, very weak. And then compare it to something like energy. 95% of the energy sector is still above the 200-day moving average. Yet it gets no respect relative to the attention all year that was paid to semis or discretionary. It's a very, very wide divergence between how good energy is and, frankly, how weak the rest of the market is.
So would you say that something is breaking and we just don't notice? That basically the overall average market-weighted S&P index has papered over some of the breakages that we've seen under the hood?
Yeah, typically, you'd look at, say, the 200-day moving average on the S&P and say, listen, it's upward sloping, we're correcting in an uptrend, and therefore we should look to buy weakness. I think we have to nuance that a little bit this time because the underlying trends, when you go stock by stock, are so poor. And that's what's been so unusual about, we're almost 12 months off the low here. And we never got more than 65, 70% of the S&P above the 200-day moving average. That's very unusual for the first year of a new bull market, which tends to be the broadest, the rising tide, the fun part of the cycle. That hasn't happened here. So my suspicion is the market all year has told us that it's not convinced we've seen the worst part of the business cycle. And that's how I want a position behave.
At this point, you said that we could get up to 510, 520 on the 10-year yield before something starts to reverse. What's your sense of what's behind this? I mean, as a trend follower, is this something more than simply people just pressing a sell button if everyone says that they're buying and there's no evidence in yields?
Well, I think the supply story has certainly been well talked about here. I find it interesting that the shape of the curve has kind of begun to bear steepen here, and bear steepener is very rare in developed economies, actually quite common in developing economies where inflation issues have been more frequent. I think that's a possibility. I also think, Lisa, as you and I have talked about, there's some structural changes here as well. The Chinese are sellers, the Japanese are sellers, the Saudis are sellers. So you have three relatively large buyers or traditional buyers of U.S. Treasuries who are not kind of on the playing field anymore. Those seem to be pretty massive shifts in how we should think about the structural call.
Do you have a decent understanding of where the buyers will come from?
No.
With that in mind? That's a problem, isn't it?
I don't. I mean, I think at some level there's an attractive yield where you want to be a buyer of bonds, and I keep going back to this idea of, okay, at a minimum it's got to be 200 basis points above CPI. That's just been the historical relationship. So if it's 350, maybe it's 550. It's 3, maybe it's 5. But this is going to be a very unsatisfying thing, what I'm about to say next. Yields will go up until they don't. Right? That's what happens every cycle. They go up until they fall.
Let
me make a banner here.
Well, Chris, this is important. It's that morning. What does that morning look like? Can you just give us an idea? How people understand how to identify that moment. They go up until they don't. What does that mean?
One of the first things I would look for some capitulative volume in TLT. So TLT is the long bond ETF. You've been doing 40, 50 million shares a day there. I think at the 2020 kind of COVID inflection point, you did 80 or 90 million shares a day. That really reflected panic or fear. I want to see something like that. The flows continue to just pour into TLT. So don't we need to see some change there, right? My experience in this business has been a move reverses when the flows get extremely lopsided on the other side, and we just haven't seen that there yet.
Yesterday with Eric Davis of BMO, Montreal, and Toronto, I was talking about the pointiness where this gets solved. Ben Laidler out with a great note off your idea of bear steepening. Laidler saying it's an unsustainable bear steepening. And in foreign exchange, it's expressed with, say, dollar loonie, where you get weak Canada. And Martin Feldstein was great on this. Feldstein at Harvard was great on this. It gets pointy, and then it fixes itself fast. Did you anticipate that some of these excessive moments here in September will, quote unquote, fix themselves fast?
Well, I do, and I think you make a great point about the bear steepener. They're bear steepeners until they're not. Yeah. And the two bear steepeners we've seen historically are second half 1969 into the 1970 recession and then second half 73 into the 74 recession. The first half of those steepeners were bear steepeners. And then what happened in the second half is what always happens, bond yield ultimately fell. So I think we'll get there at some point. What's unique about those recessions is bond yields didn't fall until you were well into the recession, about halfway through. And that's such a departure from what we're all used to the last 40 years, where bond yields would fall in anticipation of a slowdown. That was not the case in the 60s and 70s, and it's kind of the framework that I want to take here.
Yeah. Is it time for a nerd banner?
Yeah.
We should have a nerd banner on TV. We can do this
Always.
on radio as well. The pointiness of stochastic moves. This is anathema.
That works
to me,
so well on radio.
It does.
works everywhere.
For me and Chris Ferrone, this is the heart of the matter. You can't catch a falling knife. You can't play a stochastic move. You got to find the trend and stay with it until it's not there. Did I do okay there?
I think pretty good.
Okay, thank you.
That was perfect, TK. Chris, thank
Canadian
you, sir.
dollar
Thank
is
you.
a
It's good to
perfect
see you.
example.
Chris Ferrone, a strategist. TK, to your point, we caught up with Ian Lingen of BMO a number of weeks ago, and we said, was the bond market, the 10-year, a screaming buy? And he replied, he thinks it's a screaming buy. This is Ian Lingen's current stance on things. We remain reluctant to stand in front of any further weakness in treasuries, Tom, given the breach of 450 on 10s. That's where even the bulls are at in the bond market now.
I would say in radio and television, stay with us through the morning. This is extraordinary, some of these summed moves we're seeing.
Looking forward to it. Hey, Chris, fantastic to catch up, as always. Coming up, Ed Mills of Raymond James with the threat of a government shutdown looming. Your equity market trying to bounce here, up by 0.3% on the S&P 500, coming off 3-month lows at the close yesterday. In the bond market, yields retreat, down 3. Your 10-year, 4.49. From New York, good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We'll be bringing up 4 of the appropriation bills we've been trying to do since July. Finally, we got the members together to be able to make that happen. If we're able to finish those 4 along with the ones we already, that would make it 73% of all the discretionary funds that we're supposed to appropriate for this time. We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Our Speaker, Kevin McCarthy, as we inch closer and closer towards the potential, the reality of a government shutdown. Live from New York City this morning. Good morning to you all. Trying to bounce after a decent day of losses on the S&P 500. This morning, positive by 0.28%. You both caught up with Mike Wilson at Morgan Stanley. I imagine Mike Wilson's feeling better about 3,900 year-end on the S&P. Bramo, did you get that impression?
I got the impression that he felt a lot more conviction taking a look at consumer stocks and saying, look, this is exactly what we thought would happen, and it's showing real weakness at a time where people are feeling the bite. He said it's only a matter of time. We're clearly at end of cycle.
So end of cycle, late cycle stuff. Did he say anything about playing the recovery?
It was too soon to get there for him, but he did talk about how then you can go more whole hog into some of these areas that are most beaten up. And yes, he was like, we're late cycle, getting close to that end, but it could take another year. And that's the difficulty. Yeah. He said, you just can't game that out.
The major message from Mike Wilson, and I think so many people watching and listening disagree, is you got to be in the market. He's not in love with being in cash. He wants to participate even within his caution, somewhat like what we get.
So energy, industrials, late cycle things for him?
The usual Wilson victims. Okay. I mean, I get that, but the panic right now in the modern financial media is go to cash. And, you know, right now, this Wednesday morning is a massive go to cash.
That's your
morning.
Tagline.
It is.
Triple leverage.
Well,
all cash.
But it's not, I get really upset. I was at the Savoy, John, in London, and somebody comes up and goes, you must be killing it. I go, the carry on the leverage is killing me. I mean, you don't get the gross
Only
yield.
You would get real
I don't
upset
think people understand. And
in the
3
Savoy.
times 5 is not 15% rounded up. You got to mark that puppy down.
Okay. Should we finish on foreign exchange just briefly, TK? This move in the dollar.
Ed Mills is looking at me like I'm nuts.
Dollar strength. Ed Mills of Raymond James coming up shortly on the potential for a government shutdown and a whole lot more. Just want to touch base with the euro, 105.59. Yeah. Currency pair negative 0.1%. To touch base with the yen, 4 days of yen weakness. And Tom, on dollar yen, we're pushing 150, 149.21. This dollar, a whole lot stronger.
We'll do a lot more data checks on that as well. And again, yen 149.20 is there. That's all that has to be said. And it'll be interesting to see how Japan reacts to what we see. As I said earlier, I'm mostly focused on the tangible market. Part of that tangible market is our politics of this nation. Thrilled to have on set this morning Ed Mills. He's Washington policy analyst at Raymond James. Does a lot of work with Carolyn Maloney, among others, and out of Boston College, where you learn politics quickly. Ed Mills, have you seen this before? To me, a president on a picket line, it's original, but is this an original talk about shutdown?
It's not an original talk on shutdown. At Raymond James, we have enough data to go back to 1995 and say, like, what happens in each of these shutdowns? And what we found was actually somewhat counterintuitive, that on average, the market is up about 3.2% during government shutdowns. So that tells me that the shutdown in and of itself should not be a driver for this market. We have a lot of other kind of headwinds that we have to focus on. Kind of the debt service burden for this country, longer term fiscal trends, but government shutdown, I don't have a huge concern about market implications for
You and I know the photo when you were at Boston College of Tip O'Neill sitting with Howard Baker, and somehow they got things done. That's not happening right now. How do you get to compromise in a fractured Washington?
Very different world. I have been focused more on the Senate than on the House, and I think almost all of the headlines have been about the House of Representatives, when in reality, the Senate, either sometime in the next day or two, maybe past October 1st, is going to pass a continuing resolution, and it's going to have well north of 75 votes. Once that's done, the pressure is going to build on the House to at least have a vote on that. If they have a vote on what passes the Senate, I think there's probably more than 300 votes on that bill. Why that's important is that if you can get 300 votes, you don't have to go through the Rules Committee. Kevin McCarthy does not have to have a fight on the floor where he has to have Democrats supporting even having a conversation of the bill. Just put it on the suspension calendar and get that done.
So just to put a bow on that, are you basically saying that there's a good chance that we're going to avoid a shutdown more than the market's certainly pricing?
So could we have a shutdown for a day or two? It's certainly possible because we're looking at the timing of how the Senate is working on this. But if there is a shutdown, I don't think it's long lasting because the pressure is going to build so much on the House to have a vote on what the Senate passes. So look at what the Senate does, and if it's 75, 80 votes on that continuing resolution, I think that's a really positive sign. And another positive sign could be if the House is not able to do their own CR. That adds to the complication if they can do that later today.
Moving away from the crystal ball of Washington politics, there's a question around the actualities of the moment. We were talking about the dollar being stronger. And this comes at a time after years where a lot of nations were looking to depreciate their currency. Is the stronger dollar actually a benefit right now to the Biden administration?
Lisa, I could argue yes. And when I have been on trips to Europe and European investors, they think that the Federal Reserve and Treasury are in cahoots here, that all of the push for kind of rebuilding the industrial base of the United States through the Inflation Reduction Act, CHIPS and Science Act, bipartisan infrastructure bill. If you have a strong dollar, it is cheaper to manufacture things here in the United States. And to the extent that that's supporting that fiscal policy in the background, I do think that's an underappreciated aspect of what the Fed has been doing.
Do you think that that's valid in any way, shape, or form, or just conspiracy theory from people who kind of have sour grapes about the fact that they feel like they're on the left foot?
Well, I think there's two things, Lisa. One, this is the first time in generations where we have challenged the industrial base of Europe, right, rebuilding it here in the United States. Two, the Treasury Secretary used to be the Fed chair. And so I do think there might be a few kind of conversations and a little bit of work together between the two.
Tell me about the debt and the deficit. Maya McGinnis was on yesterday and was just brilliant about the new of the debt and the deficit. You are a grizzled pro at this. Are you concerned about our debt and our deficit?
I have a growing concern. I mean, one of the things that we look at, if you check the national debt and the debt service burden, the debt service burden is going to eclipse what we spend on discretionary spending, all of defense and non-defense discretionary spending pretty quickly here. So for years, when I first came to Capitol Hill, being concerned about the debt and the deficit were front and center. Last 5-10 years, that really went away. That's returning, and that's going to have a huge impact on our politics, and ultimately on kind of what we're able to spend. When I look at the 2024 election, probably one of the biggest decisions that's going to be made based upon who wins is the tax cuts that expire in 2025. That's another $4 trillion if you want to extend those out. And so if you are kind of having a conversation about the debt and the deficit, what are you going to do with those tax cuts? What is the implication for the economy, especially on the individual side? Because those are the parts that expire.
It's such a good point, but you know how this works. You get into power and all of a sudden you don't care about the deficit like you used to. Do you think that's going to change?
No. I've always said that the kind of members of Congress really care about the debt and the deficit when they're in the minority.
Yeah.
And one of the big concerns is that the way in which you think you should solve it is different. So Republicans like to kind of grow kind of revenues through kind of tax cuts, and Democrats try to feel they want to grow revenues through tax increases.
Unless, of course, the market forces that discipline onto Congress and Washington in a way, Tom, that it hasn't for a long time. That would be the change.
One final, just quick, I'm so sorry for this. It should be a longer question. Do either of these parties feel like they're in the minority? They're both acting like they're in the majority.
I think that when you are in the White House, that's kind of what sets it. So yes, Republicans have a majority in the House, but in reality, with the Senate a Democratic majority, Joe Biden as president, they kind of can push on the president and make him have kind of tough conversations.
Ed, thank you. Smart as always. Ed Mills and Raymond James up here in New York on the latest down in Washington, D.C. Coming up shortly on this big move in the FX market, Steve Englander, head of G10 FX research at Standard Chartered. We'll be catching up with him in just a moment. Lisa, the scene, the President of the United States in the last 24 hours on the picket line.
I wonder what the Fed thinks. Keep asking for it. Come
Ask
on,
for that
ask
40%.
for those wage increases when they've already accepted 36%. I mean, really, this is going to really offer a conundrum to the Fed.
It's pretty remarkable to see, isn't it? Live from New York City this morning. Good morning to you all. Equity futures up here by about 1/3 of 1%. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Live from New York, here's the price action. Equities look like this on the S&P, positive by a third of 1%, trying to bounce up a third of 1% also on the NASDAQ. Yesterday at the close, the NASDAQ 100, the lowest since June 9th on the S&P 500, taking back the summer, the lowest since June 7th. That's the equity picture at the moment. The damage in the bond market, yields unbelievable. New closing high, 455. We're pulling back a little bit, down by about 3-4 basis points on a 10-year. New intraday high, Tom, 456.22. On a 10-year. It's quite a move, TK.
And it's correlated here. Oil didn't participate the last couple of days for other reasons, cushioning that. I got Brent crude 95.17, which gives you that high yield tinge. You see it in the foreign exchange market. Pick a pair, John. We didn't. Lisa and I didn't think you were going to come back from London. You were looking for real estate in Kensington.
Well, funded in dollars and looking at cable breaking down. Why not?
I mean, 119. I mean, you're a landowner, but you can take the whole yield discussion, folks, and you can go nominal yield analysis, as John just did, or inflation-adjusted analysis, and it's wow. It is a wow Wednesday.
Well, let's get to the wow of the FX market. The euro at 105. This would be week 11. 11 weeks, 11 consecutive weeks, Lisa, of euro weakness and dollar strength. And we're close to it right now at 105.59.
Russ Kostridge of BlackRock yesterday said that the one conviction trade, the best hedge against stock weakness right now, is the dollar. And I thought that was interesting. Bonds aren't working as the offset, as the hedge in the same kind of way, but people are using the dollar in that sphere because strength is outperforming in that region.
The dollar index, Lisa, here at about 106, heavily weighted, of course, to the single currency. Tom, I know you've been following the yen over the last week or so. Yeah. To see that get closer and closer to 150, and you've been right to be on top of it, Tom. Big question, where's the line in the sand for the BOJ? To start making more noise and start doing something?
I think it's a mystery. With Englander coming up, we can ask him. But the bottom line is, I don't think there is a line in the sand. They've got to look at it within a set of moving parts, including Australia yen is a Pacific metaphor.
Dollar yen right now, 149.17. Under surveillance this morning, President Biden taking to the picket lines, endorsing the UAW pay demands. Biden telling automakers striking against the big three to, quote, stick with it. You deserve what you earned, and you earned a hell a lot more than what you're getting paid right now. Lisa, remarkable scenes. And to your point, just compare and contrast what's coming out of the Federal Reserve to what you're hearing from the president.
That, I think, is the biggest tension, especially if other people are taking cues from this, saying now is our time to get more of the corporate profits than we got in the past couple of decades. Key question to me is how much are we going to hear an echo of this by the former President Trump, right? Either side is trying to play to the anger that you're feeling in the worker. And it's, you know, regardless of anything else, that is the focus right now.
Look, this is like Kroger's. There's no corporate profits. You can talk about executive pay and all that. They're running an EBITDA line at GM of 10%, maybe 12%. They're bringing it down to the net income level of 6 cents on the dollar. John, that's like selling bananas in the produce section.
Let's build on that because I'm totally with you. There's something very bizarre about taking shots at Wall Street on the picket line with UAW, because I can't think of many people on Wall Street that have made money investing in GM stock over the last decade, with the exception of a 12-month period coming out of the pandemic. That stock, Bramo, has been dead money for the best part of 10 years.
It doesn't cohere with this feeling of roaring strength. What it coheres with is a feeling of being bottomed out in the industrial sector. And the real question is, where is the debate going to hinge? Is it going to be, I'm standing with you, or is it going to be, what should our industrial policy be and what brought us to this place? And I think that's what's underpinning anger politics, which you're hearing right now.
I had the privilege of catching up with Alarian, Spence, Brown on their new book on permachrist, and thanks for the feedback on that. There's an amazing stat in that book, Tom. Have a think about this. 1990, China's share of global manufacturing, 3.5%. 2021, China's share of global manufacturing, 30.5%. Totally hollowing out domestic manufacturing bases in developed countries and sending it away. And this is the backlash. We saw the backlash in the politics of 2016. You're seeing the backlash on your screens in Detroit.
And even if it goes to other nations on the Pacific Rim, there's intermediate supply development where a lot of it's still being done in China. And to be fair here, John, there's a domestic and international China discussion, and people feel actually China, away from the real estate debacle, may be doing better than good. Maybe not 7% GDP, but okay, John, General Motors, the last 10 years, annualized return off the Bloomberg Professional Service, 2.02%.
Yeah, that's not getting it done. No. Wall Street weren't the winners of GM in the last 10 years. The winner's been the leadership, and we've talked about executive pay, and we'll continue to talk about executive pay at places like GM. A couple more stories to get through. U.S. government shutdown nearing its Saturday deadline despite incremental progress. The Senate introducing their own bill that would extend funding to November 17th, but no clear path for the bill to overcome a deadlock in the House, which is set to vote on its own measures. In about 60 minutes from now, we'll catch up with AMH down in Washington, so look out for that conversation. And I wanted to finish with this one, Lisa. Evergrande troubles deepening. The chairman being placed under police control. This according to people familiar with the matter. The billionaire said to have taken away by Chinese police early this month, and it's being monitored at a designated location, adding to questions, Lisa, about the company's fate and, of course, the chairman's fate for that matter as well.
Especially since he was one of the most highly ranking Communist Party members and actually was incredibly politically influential, one of the richest Asian influencers out there. He's worth now about less than $2 billion. At one point in 2017, $42 billion was his net worth. He has fallen off. I wonder what this means. He's being detained, sort of, but he's not going to necessarily be arrested or charged. I don't understand. 6-month time frame seems to be the official limit, but what is going on?
With the foreign minister, the defense minister, I'm not going to comment on that. What I am going to say is, how's it going to be expressed? The easy answer is simple. Weak renminbi, weak yuan. Is it unimaginable, is 2.22% 10-year U.S. real yield? John, is it unimaginable to see weak yuan back to where it was in October of 2005?
That's the latest this morning, TK. That story, I can tell you, getting a ton of buzz, one of the most read stories on the Bloomberg terminal so far today.
This is a privilege. We love the guests we have, and particularly when they're so good at foreign exchange cross rates, like G10 FX strategist, global head of G10 FX research at Standard Chartered, Stephen Englander, joins us for Global Wall Street this morning. Let me start there, John. Stephen, rather. John and Lisa have a lot to talk about. Is it unimaginable that we will see a devaluation of yuan renminbi out back to where it was long ago, fixed at a 750 level?
I've come to learn that our imaginations are pretty limited. It's certainly not the most likely scenario out there. I mean, the key problem that China has is domestic. It's not its trade balance. With the world growing so slowly, the odds that it can export its way out, especially given concerns in the U.S., concerns in Europe, concerns in elsewhere about the China trade surplus. They're going to have to solve their problems domestically. The exchange rate can help a bit, but it's not going to help a lot.
What do institutions do when you have not a Plaza Accord dollar strength, but what we've got right now? What would you expect the Fed to do, Treasury to do, and other central banks?
Well, look, I think the U.S. is focused domestically unless there's something that really breaks internationally, and so far that hasn't happened. I think there's a mythology about the Plaza Accord. I mean, the reason you get into a plaza is because you have common interests. As long as the interests are not common, it's, the only rule is every man for himself. So each country is pursuing its own policy to its own advantage. And what we're seeing in markets is how that plays out.
Steve, what do you make of Ed Mills' comment that there is some sort of tacit, I don't want to say working together, but acknowledgement that a strong dollar by the Fed, by the Treasury, is a positive for the industrial policy of the U.S.?
Look, there could be something to it. I think that it's probably helping a bit on the inflation side, combined with the deflation that we're actually seeing in China and in Chinese imports. I don't, given all the geopolitics driving trade flows, I don't think that exports and imports are as sensitive to exchange rates as they used to be. So it could be that we're kind of getting some of the benefits. We can get a cheap hotel room in Paris, maybe not Paris, but elsewhere. But I don't think it's kind of the biggest deal out there. In fact, I'd say probably if you're at the Fed, you're kind of saying maybe we get some modest benefit from this, but we have to spend a lot of time making sure that the rest of the world, and particularly parts of the world that have dollar debt, that the strong dollar really doesn't lead to some kind of financial market accident. So, I'm on the fence on that one.
How close are we to that, Steve? Some sort of financial market accident?
Look, it's not imminently visible, but what we're seeing are things like the KRE index losing, the regional bank index kind of going down pretty much, 2 days out of 3. So there is some concern there. There's pockets of concern elsewhere that certainly isn't helping. The world isn't growing nearly as fast as we expected, and less so than the strong dollar. The high U.S. rates are not helping that growth picture, but there's nothing that's around the corner.
We've been talking, Steve, about a stochastic move where things weaken, like Looney weakens out to 138, 140, 142. And if you look at a chart, the fact is it always reverses abruptly to stronger Looney at some point. Is that what's going to happen this time? We're going to have whatever the events are, and then quickly they will turn around?
There is something to that. I mean, obviously rate differentials have to help, but I think if you're in Canada, going down to Florida, you can't afford to buy a beer because, Canadian dollar is so weak, or if you're in Japan and you can't travel because your currency is so weak, it becomes a political issue. And there's nobody arguing that in Japan that we're doing great because we're so competitive, or in Canada that we're doing great because dollar CAD's 130, 135 and a half. So I think something usually happens. What kills people in the market is they're getting the timing wrong. If you can get the timing right, you do very well. But the risk is being premature on those moves. But we think it's kind of toppish. I mean, we don't see the Fed raising rates. We don't see them cutting rates anytime soon. So I think there's a lot getting built in that's momentum right now.
How much is this a dollar story, and how much is this an everything else being weak story?
Everything else being weak, 70%. The dollar strength story, 70%. I know it's a Yogi Berra kind of calculation.
He's on.
It was a Bramo classic, Steve. That was a tough one to answer. Steve, I was curious from your standpoint, just to wrap things up, this combined weakness in the euro and strength in crude, to borrow some of Lisa's wording, just how toxic that is for the ECB at the moment. What do they do with that as the backdrop?
Some of the chickens are coming home to roost. Some structural chickens. I mean, their energy policy hasn't really been successful. Their innovation policy hasn't been successful. China's on the fast track on electric vehicles. The sources of growth there. I mean, I think Europe is a funding currency. Actually, Swiss is a funding currency, becoming much more attractive over time.
Steve, thanks for the update.
They're going to get paid for what they do.
I think you're done now. Steve Englander, a Standard Chartered. Steve, sorry. Going to catch up as always. Let's just finish on that point, Lisa. It's so important. Where this leaves the ECB, the European growth model, to see the euro breaking down to 105, to see crude in the 90s. What do you do with that?
There is no clear answer. And you can hear that from some of their discussions where they want to get inflation down. Stagflation is not going to be their base case that they're going to be happy with. At the same time, they're between a rock and a hard place. There's no good answer. If I knew the answer to that, I'd be in a very different position.
Oh, big time. You'd be in Lagarde's seat.
Exactly.
Maybe, although I'm not sure what Lagarde would say this morning either. What does President Lagarde, Tom? You've spoken to her recently in the last month. Where does she see things
This
now?
is really important. This came up yesterday, John. You nailed it. Her speech that she gave in Jackson Hole is not implementable given these markets. You go right back to massive short-term data dependency, which she and Philip Lane are pushing against. You can't have a 60,000-foot plan when you got stochastic moves out there.
Lisa, I'm sure you saw some of the credit data coming out of the ECB, coming out of the Eurozone. It's not great, is it?
It's devastating.
Pretty
it's
bad.
worse than what we've seen even during the Euro crisis. So what do they do with that? I mean, is this lag effect? Is this being worked through and we just still have higher prices simply because crude and natural gas are going up?
I feel bad for Steve now for cutting him off. I thought he was done.
So, you know, it's
sort of
okay.
sound like
Steve,
he was
you were great.
done. Steve was great.
You're
Steve's always
70%
great.
done, 70% not done.
Yeah, you know, I think I did him a favour anyway, sort of getting him out of answering that. Equities on the S&P, positive here by 0.3%. Live from New York City. Good morning.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Without accountability, the independence of the Fed is going to be challenged going forward. So the Fed has huge interest in embracing the few things we propose in order to restore trust in an institution that's absolutely critical and that must have political autonomy.
Always fantastic to catch up with Mohammed Al-Aaron of Bloomberg Opinion, economist speaking alongside the former Prime Minister Gordon Brown and Nobel laureate Michael Spence on their new book, Permacrisis, A Plan to Fix a Fractured World. Catch the full conversation on Bloomberg.com and on YouTube as well. Let's turn to the price action. If you are just joining us, equities trying to bounce here by 0.3% after closing at 3-month lows. All that happy talk, that soft landing, hope and dream through the summer. We take it all back. The equity market back down to levels we haven't seen, TK, since early June on both the S&P 500 and on the NASDAQ too.
Yeah, there's a lot to look at here today, and you can look at it across currency pairs. As I've said time and time again, John, FX is the deepest system out there. Some things are on. Every day it varies. Like sterling's really not part of the story today. Maybe sterling will, hit a 120, 119 tomorrow. Who knows?
But the euro is, the Japanese yen is, DXY at 106, euro dollar 105, dollar yen, Tom, very, very close to pushing 150. And you've been asking a question as the right one. At what point, Tom, does the stress get too much for the BOJ? Where's the line in the sand for them?
Well, Steve Englander off the camera, folks, wasn't going to give us a level here. I don't think there is a level to know, but what he said is so important. This is institutional and political as well. 106 DXY. I mean, is Chairman Powell waking up this morning, looking at his Bloomberg, watching surveillance, going, OMG, we got to act? But can you imagine a 108? I've never framed 110 DXY, and that's my mistake.
To Bramo's point, though, does that do some of the work for this Federal Reserve? Higher real yields, stronger dollar. Isn't this part of the objective? To put the brakes on the economy And Tom, ultimately, to help bring down price pressure, does the dollar contribute to that effort?
The dollar contributes to everything, but I look at it as an identification of the system, and particularly around yields. This is a joy, and particularly for our American audience, listen carefully. It is rare that you can say a person, a CEO, turned around an airplane. If you're out at JFK or anywhere across America, there is Iberia. It is of Spain. And Luis Gallego, I hope I'm pronouncing that correctly, probably butchering it, but he did it. He did what we wish they would do in America, turn around an airline. In conversation with our Guy Johnson, IAG CEO, British Airways is his fault. Guy, please help us here at your aviation festival with a gentleman of Iberia.
We're here in Lisbon, Tom. Luis Gallego is the CEO of IAG. IAG, the holding group for, as you say, Iberia, British Airways, Aer Lingus, the list goes on and on. It's one of the big three holding groups in Europe that owns the vast majority of Europe's airlines. You guys were just talking about what's happening with the dollar. The other thing that's kind of floating around this industry at the moment is what is happening with fuel. Fuel prices absolutely rocketing higher. You've got Brent obviously surging, but the crack spread on top of that to make jet fuel also super wide at the moment, which means jet fuel is very expensive. Luis, great to see you. Thanks for stopping by to see us. Does higher oil, does higher jet fuel mean higher fares?
Fuel for us is 25% around of the total cost, but in IAG we have a hedging policy. So for this year we have above 70% of the fuel cover, and next year is around 40% now. Yep. So at the end, the fares are related to the supply and the demand and the competition that we have in our different markets.
Okay, your competition is really important. The American carriers don't hedge. Yes. So you're hedged. Your American carriers, the competitors on the North Atlantic, are not hedged. Do you have an advantage right now because of the higher fuel price on the North Atlantic versus those American competitors?
In North Atlantic, we have a joint business with American Airlines, with Finnair, British Airways and Iberia, and at the end we have a profit pool of revenues that we share between the different airlines. So we have metal neutrality. The customer, they can fly in the airline that they choose. So at the end, all the benefits we share.
But nevertheless, versus the other groups outside of your group, do you think you have, if they're not hedged, are you making more money right now on the North Atlantic?
I think in general in the States they don't hedge. In Europe we hedge, so at the end we are balanced.
Okay, it balances itself out. How is demand on that you're seeing at the moment? I'm hearing the banks aren't spending big at the moment. I'm hearing that big tech is not spending big. What's happening with demand? What's in particular happening with business demand?
So demand is very, very strong, particularly leisure demand. Premium leisure traffic is amazing. The corporate traffic is the one that is lagging behind. We are still, for example, in levels in BA in the second quarter of around 60% in volume, 70% in revenues of what we had in 2019. In the case of Iberia, it's better. It was around 80% in volume, 90% in revenue. The main reason is they operate in different markets, but also I think in Spain, the people after COVID, they came back to the office before what is happening in UK.
You and I have just been on a panel with Luis Rodriguez. He's the guy that runs TAP. There's going to be a cabinet meeting tomorrow that's going to determine kind of what happens next in the privatization of the Portuguese flag carrier. Have you had a little conversation with him? You've expressed interest in maybe bringing TAP into the IAG group. Do you think why is that the right call? Why are you the right potential owner for TAP?
First of all, we want to see what are going to be the conditions of the privatization. But we are a group that was created in order to consolidate the sector. And we have excellent brands, excellent airlines below us. So TAP, I think, is an operation that could be interesting for us. And I think the model that we have is the right one for a company of of the size of TAP. They can have the advantage to belong to a group like us, but to have the freedom to preserve the brand, to preserve the customer, to be accountable of the P&L. So I think what we have shown in the past is that all the airlines joining the group, they have developed much more than when they were alone.
Do you think you can own Iberia, Air Europa and TAP?
Yes, we are sure, because I think Iberia and Air Europa, we are in the middle of the process with the competition authorities. This is an operation of consolidation in the hub of Madrid. But TAP, when you look at the markets TAP is operating, mainly is Brazil, that we don't have a lot of presence there, and also the former colonies of Portugal. So I think the networks are very complementary, and that's the reason we can operate, for example, with a dual hub strategy in the same way we have Dublin and London in the north.
Can I just talk to you about what the future of this industry looks like? Is flying going to become too expensive because of the journey that aviation has to go on to get itself to carbon neutrality? We talk about SAF, sustainable aviation fuel. It is going to be, jet fuel is expensive. Sustainable aviation fuel is going to be epically expensive. Do you think people are going to be able to afford to fly when we make this journey, when your aircraft are powered by sustainable aviation fuel? Is it going to be too expensive for all but the very elite?
I think it's going to be more expensive. The question mark is if it's going to have an impact in the demand. We think that we can decarbonize aviation, but maintaining fares that can be affordable for the consumers. And we have a lot of people that they say we are ready to pay a little more in order to fly in a sustainable way. So I think that's the challenge, but we don't have any other alternative. We need to decarbonize aviation.
The British government is already starting to back off some of its sustainability targets. Do you think you could see aviation maybe being set looser targets? Do you see that coming? Do you think it's a mistake that the British government is backing off its targets?
I think we need to maintain the ambition, because otherwise we are not going to achieve the commitments of to have net zero emissions by 2050. The main issue is that we don't have SAF enough to comply with the mandates that they are putting in place. So